Hi everyone, today we are starting with the chapter number 7, that is mutual fund. Now this is a very simple chapter. So what are mutual funds? So mutual funds are the alternative ways for investment. If you want to make investment, you can directly make investment in equity share or debt instruments by yourself. Now, but if you don't have enough time to research the correct equity share and the correct debt instrument, or if you don't have expert knowledge to make the investment decision, in either case you want to make the investment but you can't make investment. So in that case you can make investment in mutual funds. So in mutual funds, the funds are being collected from general public and they are invested by an expert. So this is the normal working of the mutual funds. So you must have heard the statement that is mutual fund sahi hai. So there is promotion for making an investment. The advertisement is promoting the investment in mutual funds, that is mutual fund sahi hai. But we all hear the sentence that is the mutual funds are subject to market risk. So even though the experts are making the decisions for making an investment, it is not that mutual funds are completely safe. So if you want to make investment in mutual funds, then also you should have the knowledge of type of mutual funds, because there are various types of mutual funds. You should know in which you have to make investment, and you should know whether that mutual fund is performing good or not. So you should have some basic knowledge for understanding the aspects of the mutual funds. So we will first learn about the mutual fund structure. We will learn this with the HDFC mutual fund. So HDFC mutual fund is a mutual fund. Every mutual fund is being managed by the AMC company. So HDFC mutual fund is managed by HDFC Asset Management Limited. So over here, AMC takes up the day-to-day activities of the mutual fund. Now there are sponsors who create an AMC. So in HDFC, AMC, HDFC and Standard Life Investment, they are the sponsor for this. Now sponsors give at least 40% of the capital and they make the application with SEBI to register an AMC, and then AMC creates a mutual fund that is in a form of a trust, and then this mutual fund launches the various scheme and the investors can make investment in the different schemes according to their requirement. Now whatever securities are being held by mutual funds, so we can say that we are making, the general public is making an investment, but this investment is done by mutual funds. So mutual fund is taking an investment on behalf of the general public. Over here, the securities owned by the mutual fund, they will be held by the custodian. Custodian is a company which holds the securities which are owned by the mutual fund. So in HDFC mutual fund, custodians are HDFC Bank and Citibank. So they hold and manages the securities in behalf of HDFC mutual fund. Now all this process, all the entities involved in the mutual funds are being head by the trustees. So trustees look after whether all the entities are working in a right manner or not. So sponsor also have to appoint the trustees, and the 2/3 of this trustees should be independent trustees. Now this is the structure which is just for your understanding. It may or may not be in questions. So this is for understanding. So HDFC mutual fund, if you see, it was being incorporated in 1999 and the setup date was in 2000. who is CEO of that, and trustee. So this is trustees detail and other details, custodian, ICICI Bank, Citibank, HSBC, all these are the custodians who are the auditors of this. So this is the details of the mutual fund. It is also called the mutual fund house. So there are various mutual fund house which issues the investments. They issue the various schemes for making an investment. So we will learn about the types of mutual funds. So if we broadly classify the mutual funds, the classification could be based on functional, portfolio, or ownership. If we talk about functional classification, then there are two type of mutual funds. The first is open-ended funds and next is closed-ended funds. Now, what is the difference between that? Open-ended funds means these funds will continue to get the investment from public. So public can make investment in that open-ended funds anytime. And for the closed-ended funds, there is a fixed date on which the investment will be closed. So say for example, now any mutual fund is being announced and the due date for that mutual fund closing date is, say for example, 10th March. So on 10th March, the investment in that mutual fund will be closed. No one can make investment in that mutual fund after that period. So that is closed ended funds. Then on base of portfolio, you can say that there are equity funds, debt funds, and some special funds. So equity funds means they make investment in equity shares. Debt fund means they make investment in debt instruments, and special funds means they are making investment in different instrument or in the different way of investing in the market. So we will learn about this in detail also. Then we come with the ownership classification. So in ownership classification, there could be public sector funds, there could be private sector funds, and there could be foreign funds. So either they can make investment in public, private, and foreign funds. So this is based on the ownership classification. Now over here, if we see this ICICI Prudential Growth Fund Series 2 Direct Plan. So this fund is a closed-ended fund. So over here, you can see that the scheme closed on 1/2/2021 and you cannot make any investment after this date. So this was a launch date 1st August 2014 and this was a closed date. So no one can make investment in this fund after this date. And if you can see, this is an example of a debt fund, excess corporate debt fund, direct plan, growth. Now, what are these direct plan, growth? We will learn about all these terms. So over here, if you see the classification, they are having no investment in equity and they have entire investment in the debt. So this is the debt funds. First, we talk about the equity funds, in which you have four type of investments: growth, aggressive, income, and balanced. In the growth funds, the investment is made in the companies which are having good growth. And in aggressive funds, the investment is made in equity where you can earn much returns by taking more risk. So they follow the principle of high risk, high returns. Then comes the income funds. So income funds are making investment in the equity share, which are giving you regular income in form of dividend. Then there comes the balanced fund. So balanced fund make the investment balance in a way to have the income also and to have a growth also. So these are the various types of equity funds. Now, these type of funds can be a hybrid fund also. That means they are investing somewhat amount in debt also. So if we consider this example, Nippon India Growth Fund. So This is having completely equity holding. So this is having a growth equity, which are investing in the equity shares of a company which you can think that there would be a growth in. Next, Edelweiss Aggressive Hybrid Fund. Now, this is a hybrid fund, so they are having a small percentage of holding in debt also, but the major is in equity. And this aggressive funds will make an investment in the shares which carries high risk and higher return probability. Then Templeton India Equity Income Fund. So they are making investment in equity which can give them regular income in form of dividend. Then HDFC Balanced Advantage Fund. So this is a balanced fund. Over here, this is also a hybrid fund where there is investment in equity and debt also. So there is an investment in government bonds. So you can have the balance in your investment. You can have income also and you can achieve growth also. So this is the balanced fund. Then we talk about the special funds. So there are various type of special funds. First is index funds. So index funds means this funds invest into the securities which are covered in index. Then international funds and offshore funds. So these are the funds which make investment outside the country. Then sector fund. Then sector fund are the funds which make investment in particular sector. So say for example FMCG sector. So this type of funds will make an investment in FMCG's companies. Then money market funds. So when the investment is made in money market instruments, then it will be covered in the money market funds. Then there is fund of funds. Fund of funds means a mutual fund is investing in various other mutual funds. So this is fund of funds. Then capital protection oriented fund. Capital protection protected oriented fund, that means over here they will make an investment so that you will not lose your capital and you can have the income also. Then the gold funds which make an investment in gold. Then you have various other schemes like balanced fund, equity diversified fund. Now there can be multi-cap, flexi-cap funds. So flexi-cap funds means they are making investment in large cap companies also, mid cap companies also, and the small cap companies also. And there could be the individual fund also, which is like large cap fund. So they are investing only in the large companies. Then there could be mid cap fund, which can invest in only mid cap companies. There could be small cap fund, which can invest only in the small cap companies. And there could be flexi cap that can invest in all the three cap companies. Then comes the contra fund. So contra fund is generally making in decisions which are not preferable in a general market. So it work with the opposite strategy of a market. Then index fund we discussed. Dividend yield fund means which are giving you the dividend, and this dividend can be the dividend payout option or dividend reinvestment option. That means either the investors can get the dividend from time to time, or they can reinvest that dividend and get the extra units for the mutual funds. So when we buy the shares, they are in the number of shares. But when you purchase the mutual funds, they are in units. So on reinvestment, you will get the extra units every time you reinvest the dividend. Then equity linked tax saving scheme, that is ELSS, also called ELSS. That means in this type of scheme, when you make an investment, you have you can claim the income in ATC. So you have tax saving on this type of investment. Then sector fund we discussed. Thematic fund also means they are investing on some theme. So say for example, they are investing in the sustainability, like, so they would like to invest in the solar energy, renewable energies, and various other sustainability companies. Or if they have any other different theme, then they can invest in the companies which are linked with that theme. Then arbitrage funds means they are making an investment in the equity share also, and at the same time they also invest in the futures and options also, so to have the arbitrage. So whenever there is difference between the prices in the cash market and the derivative market, that is like future and options market, or there is different between the prices in two different markets, then the arbitrage funds make investment in that shares to earn the risk less profit. Risk less profit means over at one place you are getting something for 10 rupees and there is some buyer who want that thing in, say for example, 20. So you can have 10 rupees profit, 10 rupees profit without any risk. You already have buyer, you already have seller, so the profit you earn is the riskless profit, that is the arbitrage funds. Then comes the hedge funds. So we have discussed the hedge funds earlier also. Hedge funds means over here the hedge funds are available to only high net worth individuals. They can make investment in riskier assets like derivative products, so that are hedge funds. Then comes the cash funds. Then comes the ETF, that is exchange traded funds. Now exchange traded funds, they follow the returns of some specific uh, commodity, like commodity, or they can follow the returns of index, bonds, or currencies. So these are type of ETF. Then you have fixed maturity plan. That means the plans which will mature at some fixed time at a fixed rate. So all these are various type of schemes in the mutual funds. So whenever you are making an investment in mutual funds, you should know in which type of mutual fund you are making an investment, so that you can understand what would be the risk in this type of investment, and you can analyze in which companies the schemes are making investment in. So this if you go to research about the mutual funds, so you can see the various types of mutual funds: large cap, small cap, multi cap, focused, international, contra, fund of funds, thematic, sectoral, technology, sectoral, banking, dividend, yield, international funds, ELSS. So you can see various type of categories over here. So these are various type of categories if you research about them. So taking an example, so SBI Nifty Index Fund. So this index fund will follow the components of Nifty. So whatever shares are included in Nifty, this index fund will make investment in them. And over here, if you see that the SBI index, that is this blue line, is following the returns same as the index. So this is your Nifty 50. This yellow line is your Nifty 50 and the above line is the SBI Nifty index fund. So both are working in the same way, and these are having 100% equity, because in Nifty they cover only equity. Then Aditya Birla Sun Life International Equity Fund. So they are making investment in the foreign equity. So if you see their investment, that is in like Ecolab, Sanofi, London Stock Exchange. So these are all the foreign equities. So these are the international equity funds. Then similarly, you have offshore equity fund. So now this offshore funds are making the investment in mutual funds which are making investment in the international market. So over here, these are the underlying assets, underlying funds over here, like BlackRock, Chevron, Bank of America, Exxon Limited, Berkshire Hathaway. Then like you have Johnson and Johnson, Microsoft, Meta Platform. So this is the offshore fund. Then ICICI Prudential FMCG fund. So this is specifically sectoral funds. So over here, if you see, they are investing in ITC, HUL, Nestle, all the companies which are related to the FMCG market. Dabur, Gillette, Godrej, Marico, PNG. So these are investment which are sectoral funds. Now, whenever your sectoral funds, we talk about sectoral funds. So if your sector is underperforming, then this type of fund will also underperform. But if that sector is growing, then this type of funds will have also growth. Then we talk about money market fund, Tata Money Market Fund. So they are making an investment in T-bill, corporate deposits, and commercial deposits. So these all are the money market instruments in which they are making investment. Then Navy Nasdaq 100 Fund of Fund. So this is the fund of fund. That means they are making investment in other mutual funds. So over here the investment is made in Invesco Nasdaq 100 ETF. So they have made investment in other fund, that is ETF. This is fund of fund. Then HDFC Gold Fund. So they have made investment in HDFC Gold ETF, which follows the returns of the gold. So we have discussed about this gold fund in portfolio chapter. So over here, this is the price of a gold, and this is the HDFC Gold Fund return. So over here, if you see, they follow the returns pattern of the gold. Then ICICI Prudential Flexi Cap Fund. So they are making investment. So over here, if you see their holding summary, they have invested 54% in large cap, 16% in mid cap, and 4% in small cap stocks. So they have invested in all type of stocks. That is called the flexi cap fund. Then contra fund. So this perform opposite to the what market expects to. So this is the contra fund. Then you have dividend yield fund with the dividend payout and dividend reinvestment. So these are the various dividend yield funds which are giving you the dividend. So this is the dividend they have given, the date on which they have declared this dividend. Then you have dividend reinvestment. So over here, say for example, you have purchased this units at this price, so made investment of 1 lakh rupees. So this is in HDFC Balanced Advantage Fund. So this is the real investment example. So 1 lakh is invested in this and you got 307 units, and next time you got the dividend of 691. So this dividend was reinvested at this price, so you get additional units of this. So and every time the dividend is declared, you get the extra units. That is your dividend reinvestment. So this is how your dividend reinvestment work. Then you have HSBC Tax Saver Equity Fund. If you invest in this, so you cannot sell the investment up to 3 years, and over here you can claim your deduction in ATC. So this is the benefit of tax savers. Then you have ICICI Prudential Thematic Advantage Fund of Fund. So thematic advantage, this is investing in the various other sectoral funds like banking, healthcare funds, pharma and healthcare funds. So these are the different sectoral funds, and this thematic fund is investing in the various sectoral funds. So consumption fund, technology fund. Then comes the Kotak Equity Arbitrage Fund. So over here, if you see, they hold the shares of various company like Reliance, they are holding 3.11 percentage, State Bank of India, Adani, TCS, HDFC Bank. So over here, they are holding the equity. At the same time, they are also having the position in futures for Axis Bank, TCS, Adani, SBI, Reliance. So they are having the position in the equity also and position in the futures market also to earn only the arbitrage. So this is your arbitrage fund. Then HSBC liquid fund, which is your cash fund, which make investment in the short term debt instruments, that is like CD, T bills, NCDs, CPs. So this is your HSBC liquid fund. Then LIC mutual fund, S&P BSC Sensex ETF. So this is your ETF which follows the returns of S&P BSC. So S&P BSC Sensex. So this yellow line is your S&P BSC Sensex, and this blue line is your ETF. So over here, if you see, they are following the same pattern. The ETF is following the returns of the Sensex. So they will have investment in the funds covered in that Sensex. Then Bharat Bond ETF. So they have investment in the debt instruments. So this is your Bharat Bond. Then UTI Silver Exchange Traded Fund. So this is a commodity ETF investing in the silver. So they will have returns similar to the silver. This blue line is your ETF and this is your silver prices. So these are following the returns of the silver prices. Then FMP, so SBI Fixed Maturity Plan Series 91. So they are holding the debt which will be matured at a fixed time. So this is about all the plans. So if you see and compare the risk and the return between these plans, so you can say that the cash funds or the capital protection oriented fund, all these funds will have the least risk and least returns. Then money markets, balanced, then index, then income, then growth, international, thematic, sector, aggressive. So this is a general hierarchy in which you can have a risk and return. Now, when we talk about the advantages of a mutual fund, so first one is the professional management. So over here, the funds are being managed by a professional expert. Then there would be diversification. So if you want to make investment, but you don't have much amount to invest, even though you can invest in multiple shares by making investment in mutual funds. So you can take the benefit of diversification by investing in mutual funds. Then convenient administration. So over here, the administration is done by the mutual fund and the investor don't have to worry about when to purchase, when to sell. All that administration will be done by the mutual funds. Then they will have the higher returns, low cost of management. Then you have liquidity in that, so you can sell mutual funds anytime. So you can have liquidity in that. There would be transparency. So when mutual fund are disclosing their price, their different holdings, and their different expects, so there would be transparency also, and there would be other benefits also, and this is highly regulated by SEBI. So mutual funds are being regulated by SEBI, so you can expect less risk in the mutual funds. Then economics of scale, that means if the mutual funds are making an investment at a very large scale, so they can have large returns also, so they can take the benefit of economics of scale. Then you would be having flexibility as such, like if you want to make investment in multiple mutual funds, you can make investment, or if you want to close investment in one mutual fund and make that in other. And you have various other options like SIP, STP, SWP. All these options make the mutual funds investment very flexible. So these are the advantages of mutual funds. Then discussing about the drawbacks of mutual funds, the first one is there would be no guarantee of return. So even though the mutual funds are being managed by some expert, they don't guarantee the return percentage. So there could be negative returns also in some time on the mutual funds also. Then the selection of a proper fund. So if you want to make investment in mutual funds, then also you should know the types of mutual funds, so you can decide whether you want to invest in like safer funds, or you want to invest in the riskier funds. So based on the type of funds, you can decide what risk it will carry. So selection of proper fund as per your requirement is very important while making investment in mutual funds. Then comes the cost factor. So when the investment is made by mutual funds, they hire the fund managers which make investment. So they charge high salary from the high management fees in the mutual funds. So these fees are being borne by the investors in the mutual funds. Then there would be over diversification. Over diversification means mutual funds have a lot of funds, so they don't invest in, like, say for example, 5 to 10 securities. No, they invest in multiple securities like 50, 100. So there is over diversification. Then transfer difficulty. So if you want to liquidate the mutual fund, so you will have the difficulty in transferring the mutual funds. Then there could be unethical practices in the mutual funds, because over here the units and NAV, all that are being governed by the mutual fund itself. So you can have some unethical practices which can manipulate the prices, that is NAV, or the calculation of units. Then taxes. So you also have the taxes on the mutual funds. When you sell, you can have short term or long term gain on that and pay tax on that also, unless it is the tax saver scheme. So these are the various drawbacks of the mutual fund. Now we will learn about the direct plan. Now, what is the direct plan and regular plan? So there is difference between the regular plan and the direct plan. Now, this difference is that in the regular plan, the investment is made through some broker. So there would be a broker which would suggest you the mutual funds, and you will make the investment accordingly. So if there is any broker, any intermediary who is suggesting you the mutual funds and making investment on your behalf, then it is a regular plan. But if you directly know, if you know which type of funds you want to make investment in, then you can directly invest in that mutual fund by their company. So over here, the well-informed investors. Well-informed investors means the investors who have knowledge of the mutual funds. they can buy the direct plans without any intermediary, and they can buy this through the authorized branches, or they can buy it online. So they will save the commissions, and this type of direct plans will have a lower expense ratio. Then the direct plan has the separate NAV than the regular NAV. So in the mutual funds, the price is called NAV. We will learn what is NAV. So price is called NAV. So the direct plan and the regular plan both have different NAVs, because in the direct you have lesser expenses, so you can have more returns in the direct plan. So what are the differences? In direct, there is no third party. In regular, there is third party. Expense ratio are lower in direct fund and higher in regular. Returns are higher in direct and lower in regular. NAV is higher in direct and lower in the regular funds. So if you see over here, Canara Robeco Blue Chip Equity Fund. So this is the NAV for regular plan, and this is for the direct plan. So regular plan NAV is 51.54 and this is 58.56. So if you can see that the direct plan NAV is higher, and if you compare the expense ratio, so expense ratio in this is 1.7 and in this it is 0.5. So there is much difference in the expense ratio also. So this was about direct plan. You can directly buy this from the mutual fund, that is AMC, without any intermediary like distributor, broker or banker, and you can purchase this via online or through authorized branches and save the commissions. They have lower expense ratio, no distribution fee is there, and they will have the separate NAV. So this is the direct plan. Now we talk about the concept of side pocketing. Now what is this side pocketing? So if you understand this in a layman term, that means, say for example, I have 200 rupees in one pocket and I take 100 rupees from this pocket and put this in the other pocket. Then I am having 200 rupees, but it will seem that you have 100 rupees separately and the 100 rupees separately. So this is your side pocketing. Now this is not the exact concept, but it is to simplify the concept. So what is the use of side pocketing in mutual fund and how it will be done? So side pocketing is done whenever mutual fund has made investment in a very riskier company which is illiquid. Illiquid means that company is running into the bankruptcy crisis and they cannot pay any amount on that. So they are not realizing any amount by their investment. So this type of investment will reduce the returns and reduce your NAV by a lot of the lot of value will be lost with that illiquid asset. So over here, to simplify this process for the investor, what they do, they separate out the illiquid investments and keep all the liquid investments in the separate way. So over here, any holder who is making investment in such a type of mutual funds, they will have two separate NAVs, the one which is a liquid and one which is illiquid. So over here, the riskier assets will be separated from the investment and the cash holdings which don't carry risk. And money linked to this stressed assets will be locked until the funds recover the money from this. So this illiquid assets money will be blocked. Whenever they will realize the money from this illiquid assets, they will distribute that to the unit holders, and you can have the purchase and sale of the liquid assets, that is the assets investment which are good investments. So you can make purchase and sale on that. So over here with the site pocketing, the rating of a mutual fund will be increased. So whenever the rating of mutual fund decreases, and to clear out the picture to their investors, they take up the process of the site pocketing. So illiquid assets are being shifted to a site pocket, and the current shareholders can benefit from the liquid assets. So NAV then reflect the actual value of liquid assets only. So whenever the site pocketing concept is being implemented, so the running NAV will be the NAV of only the liquid investments, and whenever the mutual fund realize the funds from the illiquid investments, they will distribute that funds to their unit holders. So this is the concept of site pocketing. This was firstly started in India by Island FS. So they started with this because they were facing the liquidity crisis and they would have negative returns if they write off their exposure in ILFS instruments. So they started with the side pocketing concept. So we can understand the real example for this side pocketing also. So over here, this is a news like Tata Mutual Fund to side pocket DHFL investment. We know that DHFL investment run into the risky asset investment. You cannot realize the amount from DHFL. So Tata Mutual Fund side pocketed that investment for more, and the more fund houses to follow. So other fund houses will also follow this type of side pocketing. Then the mutual funds continue to side pocket exposure to the Yes Bank bonds. So Yes Bank also faces the crisis. So you cannot recover the amount from the Yes Bank investment. So the mutual funds separated the riskier asset Yes Bank. They did it with the side pocketing. Then Aditya Birla Sun Life Mutual Fund side pockets exposure to the SL Group. So SL Group was also the riskier asset. So Aditya Birla Mutual Fund side pocketed this. Then Franklin side pocketed holding in Vodafone bonds, and this shoot up 20% as interest flows in. So Franklin has already side pocketed the Vodafone, but when they realized the interest from the Vodafone, then at that time their prices shoot up by 20%. The asset Franklin Templeton Asset Management gets rupees 1398 crores from the Vodafone Idea. So when they got this amount, they distributed this amount to their unit holders, and this was a side pocket asset because it was a riskier asset. So this is the real life example of the side pocketing. Then comes the concept of tracking error. Now, what is tracking error? So whenever there are the mutual funds, like you consider investment funds or you consider ETF funds, so these are following the investment of something, some benchmark. So like Nifty index fund, so they will follow the Nifty. And you have like gold ETF, so they will follow the gold. So whenever you are going to track something, then the mutual fund, like fund managers, cannot track it correctly. So there would be a tracking error. Higher the tracking error, there would be higher risk. Now, tracking error is basically what we have learned about the standard deviation in the portfolio chapter. So how your returns vary from your benchmark, that is the tracking error. So deviation of funds return from the benchmark return, it is following, that is called the tracking error, and the tracking error can be calculated quarterly or monthly averages NAV. So what would be the reason for tracking error? Now the tracking error can be due to transaction cost. If your transaction cost is very high, then there would be difference in the returns. If your fees charged by AMC So if your fees charged by AMC is high to manage the securities and manage day-to-day operations, then also you will have lesser returns, which will create a tracking error. Then fund expenses. If your fund is making lot of expenses, if your expense ratio is high, then also you will have lower returns and you will lead to a tracking error. Then cash holdings. So if the fund is holding lot of cash, then they will not earn the returns on that, because you will not earn no return on the cash holdings. You will earn the returns on making an investment. So if you have cash holdings, then your returns will be less, which will create a tracking error. Then sampling biasness. So if you take up the selection of sample to calculate this tracking error, if your sample is wrong, then also you can have the tracking error, which will give you the difference in returns. So this tracking error is calculated similar to the standard deviation. If you see over here, this is a 1 year tracking error of the index funds. So Motilal Oswal has 0.2 percentage tracking error. This has mid on large cap, on mid cap and small cap. So these are the various tracking errors. So top index fund with the lowest tracking error. So this is the list, like HDFC index fund, they are having error of 0.06. Then SBI Nifty, they have error of 0.10. So this is the tracking error percentage. Then their benchmark. So this is the benchmark which they are following. And from the benchmark, what are the tracking errors? So what is the difference of the returns from the benchmark? That is the reason is called the tracking error. Now we come to a very new concept of quant fund. Now what are the quant fund? Quant fund means over here the stock selection, that is buy and sell of a stock, is done by the computer, then by the system. That means it is a data driven approach. Data driven approach means based on the data, you have developed a model, and based on that model, you take up the decision of buy and sell. So, this buy and sell is done by a system. No human is making the buying and selling decision. So, this type of fund is called quant fund. So over here, the stock picking is free from the human intervention. The data-driven approach is being followed, which is based on the predetermined rules or parameters using statistic or mathematics-based models. So you consider the various factors like the price earning ratio is this, and you can consider another factors also, whether it is overvalued, undervalued, what is the average prices, at which prices you should buy, which prices you should sell. So combining the various models, you can various factors, you can frame a model to decide the point of buying and the point of selling. So the system will work accordingly, and the entry of exit will be done by an automated program. The fund manager over here just focus on the robustness of the model. So whether the model is working properly, they will monitor the performance, whether it is giving you good returns or not. Now, sometimes there is a confusion between index fund and the quant fund, but both these funds are separate. They are different. Index fund follow the investment which are covered in the index, and quant fund not necessarily invest in the index security. They can invest in any security, and this investment pattern is also decided by a model. And if you are making an investment in index fund, so you have to make investment in proportion according to the coverage in the index funds. So in index fund, there are various securities which have different proportion in index. So when index fund make the make the investment according to the proportion in the index. And quant fund has their own choices according to the models. This quant fund eliminates the human biasness and subjectivity, which ensures the consistency. So human can be biased on some companies. They can take a wrong decision of buying or selling. So to remove the human intervention, this type of funds are being framed, which ensure the consistency in the model, and they follow the passive strategy. That means once the model is being framed, the quant fund will work according to that model. Over here, the exposure ratio will be low, and if you can follow the quant fund, then also you cannot say that you will have the higher returns or you will have the best returns. So whether it is system or it is human, both can have losses, both cannot beat the market. So it is not like quant fund can generate the best of the best returns. In that also, if your model is not working in the current scenario of a market, then quant fund also can give you less return or negative returns. So this is the concept of a quant fund. So over here, this is a real investment in a quant fund. I'm giving you the example of that. So if you see, there is being investment made in a quant fund. So quant small cap fund. So 12,500 are invested in this fund, and the market value of this fund currently is 15,255. So annualized return are 142%. So this is the investment from 25th September to 24th January. So this is made in SIP. So each and every month 2,500 investment is made. SIP of 2,500 is made in this quant fund. So each time in every month you get the units from this. So this is the return you have earned. But if you annualize this return, so this annualized return is 142.22%. So these are the various holdings in this quant fund, but all these holdings of a quant fund are being managed by some model based on some statistics, based on some mathematics. This model is being framed, and based on that model, the purchase and sale is made. So this is your quant fund. Now we will learn about the other terminologies also for the mutual funds. So over here, we discussed that in equity, we consider the number of shares, but in mutual funds, you have to consider in the number of units. So you are called the unit holders and not the shareholders. So if you buy the mutual fund, it will be in units and you will be called the unit holder. And the price in the mutual fund is called NAV. Now let us understand what is NAV. So NAV is net asset value. Now, why we are learning all the internal aspects of the mutual fund. So NAV, how to calculate the NAV, we will learn about that also. We will learn all the other aspects which a mutual fund has to deal with. So investor does not have to consider the calculation of all this NAV and various other aspects which we will learn. But as a chartered accountant, when you are working as a fund manager, then you have to understand how mutual fund works, what are the aspects the mutual fund consider into. So what is NAV? That is net asset value. So over here, this is computed either daily or weekly. So if computed daily, then it will be computed once in a day. And if it is computed weekly, then it will be computed once in a week. Now that depend on scheme to scheme. So scheme will mention whether the NAV will be calculated daily or weekly. So when you have to consider the calculation of NAV, so say for example, the NAV is now 50 and you want to invest 100 rupees. So it is not sure that you will get 2 units at the NAV of 50 and you can invest 100 rupees. So there are various adjustments made to the NAV. So what NAV you see and the NAV at which you invest may be little different. So the mutual funds have control over the NAV and accordingly will have variation in the number of units also. Now, in the mutual funds, the number of units can be in point. So, we have to know how to calculate this NAV. So, this is the calculation of assets minus liability. Now, these will be the net assets. This net assets divided by the number of units will give you the NAV per unit. Now, how to consider this assets and liabilities? So assets will be the holdings, investment you are holding. The mutual fund is holding some investments. So the market value of that investment will be considered as an assets. Then you can have other assets also, like cash holdings. You can have other accrued income also, like say for example, the company in which the mutual fund have invested, they have declared dividend, or they have invested in the debt instruments where interest is accrued, so they will receive that interest. So that is the accrued income. So that is also the part of assets. Similarly, you have to consider the accrued liability also. So whatever the outstanding liabilities are, you have to consider that. Now, if there is liability which is already being paid, then it would be considered in the cash balance. So it will not be accounted as a separate liability. So over here, you will just have to consider any outside liability or any accrued liability. So that would give you assets minus liability will give you net assets divided by number of units. You will get the NAV per unit. So market value of investment plus receivables, accrued income, other assets minus accrued expense, other payables, other liabilities. This all will give you net asset value. That divided by number of units give you net asset value per unit. Now, this is a simple example. Like securities have market value of 5 lakh, then cash you have 3 lakh, receivables 2 lakh, interest accrued 50,000. So this here is your total assets minus the short term, long term liability, accrued expenses. This is your total liabilities. So assets minus liability gives you the net assets of 6 lakh divided by number of units gives you the NAV per unit. Now, whenever the new fund, that is mutual fund scheme, is being launched, then it is called NFO. Now, we know the term IPO, that is used for equity, that is initial public offer. Whenever company raise new equity, first time equity, whenever it is raised, it is IPO, then it is FPO. But when a new mutual fund scheme is being launched, it is called NFO, that is new fund offer. Now the information for this new fund offer is given in SID KIM. SID is scheme information document, KI is key information memorandum. So this gives you the insights of the scheme, that this scheme will invest in which type of assets and how the NAV will be calculated, whether it will be weekly, whether it will be daily, and all the other details of the NFO will be given in this documents. Now, we will take an example of new fund offers. So these are the various new fund offers which are there in February. So this is like close ended, then these are open ended. So this is their open date, close date. Now, even in the open ended scheme, even after the close date, you can purchase the units. But in the close ended, you cannot purchase the units after this close date. So this is fixed maturity plan series. Then you have quant funds, index funds, mid cap, large cap funds, opportunity. So all these are various new fund offers, that is new schemes to be launched. Then we have to understand about AUM. Now this is asset under management. Now what is this? So this is just the part of assets in hand. So market value of investment plus any cash you have, that is your assets under management. So over here you don't have to consider about liabilities, just you have to consider about assets. So this is the fund which is available to the fund manager, which has to be managed. So mutual fund is having 1,000 Reliance shares, market value is this. 1,300,000 HDFC share, market value is 1,650, and they have some cash of 10 lakh rupees. So all this totals out to 39,50,000. So this is the total asset under management that the fund manager has to manage. So consider quant mutual fund. So this has the total AUM of 55,807.56 crore. So this is the total assets which a fund manager have to manage for this mutual fund. Now we will understand about loads. So there are two type of loads which are being charged by the mutual fund. The first one is entry load and the second is exit load. As the name suggests, the entry load will be applicable on the entry, that is when you are purchasing the mutual fund units, and exit load will be applicable when you are selling, when you are exiting from the mutual fund. So on selling of mutual fund units, the exit load will be applicable. Now just apply the common sense. You are a mutual fund, the NAV of your scheme is 100 rupees. You want to charge 1% on entry. 1% on entry. So what amount you will demand from the investor? So you would demand 101, because on entry you need more funds. You need more funds. And whenever there is withdrawal, say for example there is 1% exit and your NAV is 100, then you will give 99 to the investor and charge 1 rupees as your exit load. So the entry load will increase the purchase price for the investor, and the exit load will decrease the selling price for the investor. So entry load is added to the NAV to get the correct NAV, that is the cost of the investor and the amount which a mutual fund will get. So mutual fund will get 100 rupees and plus 1 rupees as an entry load. And if there is exit load, so exit load would be, they would give them 99 rupees instead of 100 rupees, charging 1% as an exit load. So when you have to calculate the selling price for the investor, you have to consider the NAV minus exit load. So this will be NAV plus entry and this will be NAV minus exit load. Now in India, generally entry load is not being charged because this will reduce the interest of investors to invest in the mutual funds. And the exit load is charged. So whenever you exit from the mutual fund, they charge you the charges for that. That is called exit load or the back end load. And this entry load is also called the front end load. So over here, there is a time specified that if you sell the units before this, say for example, before 1 month or before 1 year, then there would be exit load of some percentage. So they have to pay this charges on selling of units or switching the investment. Now you can switch the investment also from one scheme to the other scheme, and when you're switching also, then also you have to bear the exit load. So NAV is on redemption, exit load is applicable on NAV on redemption, and this is charged to discourage the early withdrawals. So you have the repurchase price, redemption price, and public offer price. So public offer price will be NAV plus front end load, and redemption price will be NAV minus back-end load. Now over here, if you want to consider that the given NAV is including that load, so the formula to calculate this will be NAV divided by 1 minus front-end load and NAV divided by 1 plus back-end load. So for back-end load, you have to consider 1 plus back-end load. So this is how you calculate the public offer price, front-end load or NAV. Then we have to consider about the trailing commission and expense ratio. So whenever the commission is being given to a fund manager, now there could be a trailing commission. That means that is calculated on the daily basis and based on the assets under management, and it is paid on monthly basis. So daily, what are the assets under management? The fixed percentage of that would be given as a commission to the fund manager, and this commission would be paid on monthly basis. So this is the amount a mutual fund investor has to pay to his advisor each and every year. So this is called the trailing commission. This is generally 0.3 to 0.75 percentage. Then comes the expense ratio. So this is the total expenses a mutual fund incurs to the net assets. This will give you the expense ratio. So a mutual fund will deduct this expenses from the NAV. So your expense will reduce your NAV and you will have lesser return if your expense ratio is more. So expense ratio is to be disclosed every 6 months. High expense ratio will lower out your returns. So this is about trailing commission and expense ratio. Now this expense ratio include the management fee, advisory fee, which is the major chunk of this expenses. It also include the marketing and distribution expenses, but it does not include the brokerage paid by the AMC. So brokerage paid by AMC will not be considered in the expense. So whenever if there is like MCQ to calculate the expense ratio, so you have to consider total expenses to the net assets. This will give you the expense ratio. So say for example, your expense ratio is 1% and you have invested 10,000 rupees. So your cost for investing, the expenses for your investing would be 100 rupees in a year. So if the fund is giving you 10% return, then after deducting this 1% expenses, you will have net returns of 9%. So this expense ratio will reduce the returns. So over here, if you see, there is a scheme objective which is giving you like expense ratio is 0.83% on this date, and charges 1% exit load. It charges 1% of the sale value if the fund sold before 30 days. So if you sell the units within 30 days, then there would be 1% exit load. So this scheme details gives you the information of about exit load, expense ratio, entry load, and all the other details. Now we will learn about the investment plan. So there are 3 plans: SIP, SWP, and STP. SIP means Systematic Investment Plan. STP is Systematic Transfer Plan. SWP is Systematic Withdrawal Plan. Now, what are all this plan? We will learn that. So, SIP, that means Systematic Investment Plan. So, over here, you are allowed to make investment in a systematic manner. So you will decide a predetermined amount which you will invest at a set interval, like monthly or quarterly. So say for example, you are investing 1,000 rupees each month. So this is called SIP, Systematic Investment Plan. So this can be as little as 500 per month. So this is like a recurring bank deposit where you have to pay money every month for your deposits, and the fresh units will be issued to you each time you make investment, and that would be at the NAV on that day when you have decided. So say for example, we are making investment on every 20th of each month. So in each month, you will have the units issued to you on the 20th November, 20th of each month. So this is how you calculate and make investment in SIP. Now the amount is directly deducted from your bank account and it is being invested in the scheme. Then it is systematic withdrawal plan. Systematic withdrawal plan. So over here you make a fixed investment and after this you decide the amount of systematic withdrawal. That means instead of making investment, you withdraw systematically. That means you decide a fixed amount which you will withdraw from the mutual fund from time to time at a set interval, so for example monthly or quarterly. So you will withdraw the amount from that mutual funds scheme, so to earn the regular returns on that. So you fix an amount and predetermined frequency of the withdrawal. So you receive the amount in parts rather than in whole. So these are more tax efficient and this can be compared to like your dividend options. So this is your systematic withdrawal plan. Then comes the systematic transfer plan. Systematic transfer plan means you have invested in, say for example, safer investment, safer to make a safer investment, you have invested in a debt fund. Now you want to take some risk also. So you will transfer some of the funds on the regular interval to a equity scheme also. So from debt scheme, regularly some amount will be transferred to your equity fund. So this is the systematic transfer plan when investor transfer a predetermined amount from one scheme to another scheme at a set intervals. So instead of withdrawing, you are transferring that amount to any other scheme. So over here, when you make investment, you will have the option, like if you have made investment, you will have the option of systematic transfer plan and systematic withdrawal plan. And if you are making investment, then you will have two options, like to make investment lump sum or to make SIP. Then we come to four type of plans. So mutual funds have four type of plans. The first one is a growth plan. So growth plan means over here, the mutual fund will pay nothing to the unit holders. So the mutual fund will receive the dividends from their equity investment. They will receive the interest from their debt investments. But they will not pay this to the investors. So this is called the growth plan. So this all returns will be accumulated in NAV. So your NAV in a growth plan will be the highest NAV because all the returns are being incorporated in the NAV. So this is a basic kind of plan where nothing is being paid out to the unit holder, whatever dividend are received or capital gains are received. So say for example, the mutual fund have purchased the share of Reliance for 10 lakh rupees and they have sold that at 13 lakh rupees. So they have capital gain also. And this capital gains are not distributed to the investor. So all this capital gains and dividend received, all the income received by the mutual fund are being incorporated in the NAV. So your NAV will grow on a higher basis. Then is dividend payout plan. So in this, the mutual fund declare the dividend for the investors. And this, the dividend is being paid to the unit holders. Then dividend reinvestment plan. So whenever the dividend is being decided, this dividend is reinvested in the scheme again and the investors are given the additional units each time the dividend is being paid. So instead of being paid to your bank account, you get the new additional units for reinvesting that dividend. So this is the hybrid plan of growth and dividend. So over here you are getting the dividend, but for growing that dividend, you are reinvesting that. And over here, then comes the bonus plan. So in bonus plan, you will receive the additional units from time to time instead of dividend or any capital gain. So this is the bonus plan where you will receive the additional units without any cost, and you can get the number of units as per the bonus ratio being decided. So over here, we are just considering a simple example very quickly. So these are the number of units. You have 5,000 units in growth, dividend payout, dividend reinvestment, and bonus. So this is the common date of purchase. This was the NAV. Now over here, consider this was on the starting date of a fund. So that is on the same basis, but as in when the fund will grow, the NAV of all these plans will vary. Now it is same because this is at the initial stage. Now the funds are being raised. This is the NFO. So at that, the NAV would be same for each, but as the time passes, when the mutual fund will have returns, this NAV will vary from each plan. So this is the value of purchase. Now, say for example, this is the NAV. So you have invested this amount. In the growth plan, there would be no dividend. So over here, you will sell this entire 14 rupees, all these units at 14 rupees. So you can realize 70,000 from this. Now, in this dividend payout, 2 rupees dividend is being paid. So it will reduce your NAV. So your NAV will be 12 and you can realize 60,000 from sale of this. Now 10,000 will be in the form of dividend received to you. Then 70,000, you have 2 rupees dividend, and considered 8,033 units are being given to you instead of dividend, because this is a dividend reinvestment plan. So now at the end, your NAV will be 12, but you will have more units in this. So you will realize 70,000 in this. So now over here, they are considering the same NAV for each and every, but when this grow from time to time, this is just to make calculation simple, but when it grow from time to time, the NAV will be different for each plan. So now over here, the bonus is issued 1:1. So you already have 5,000 units. Now you will have 10,000 units. As the number of units have increased, so NAV per unit will reduce. So now it would be half of 14, that is 7. So you will have 70,000 amount in the bonus plan. So over here, this is like the real investment. So this is the dividend reinvestment, which we have discussed earlier also. And this is the SIP plan being made. So over here, there is no dividend part. This is just investment made each and every month. So side pocketing, we have already discussed this. The original NAV will be classified in two parts: NAV of a bad assets and NAV of good quality assets. So we have discussed this to ensure that the liquidity is not a problem. We take up the side pocketing, and the investor can benefit by selling the liquid investment. So a different NAV is assigned to the side pocket assets based on the realizable value. So what you can realize from the illiquid assets, based on that you will have the NAV of a bad quality assets. So this was being first made by IL and FS. Next is tracking error. So we have discussed it is a deviation from benchmark. We have discussed the reason for that also. So if there is any calculation, but you don't have any calculation of this tracking error, but if there is any question or MCQ based on calculation of tracking error, then you have to calculate it on the basis of the standard deviation, but based on a sample standard deviation. That means in denominator, you have to consider n minus 1. So this is how you will calculate the tracking error for any mutual fund. So if you have given with the return of the fund and the benchmark, then you will calculate the difference of this returns of fund and the benchmark and calculate what is the standard deviation. Next, quant fund. We have already discussed this quant fund also. Now we come to the calculative part of the mutual fund. So all this part we have learned till now. From that, NAV was a calculative part, but rest all were the theoretical aspects of the mutual fund. Now we will learn to the practical aspects. So how to calculate the return on the mutual funds. So you can have the return on as a capital appreciation and the dividend. So you will calculate what is the difference between the NAV, that will be your capital return, plus any dividend you received or any capital gain you received. So if the mutual fund is distributing the capital gain also, then you will have the capital gain income from the mutual fund also. So this will be the income which will be distributed by the mutual fund, but this will be the change in the NAV of a mutual fund. So all this divided by NAV 0, that is the initial NAV at which you have made investment, this will give you the return percentage. So this is your return percentage calculation on mutual funds. Now, how to calculate the return of mutual fund? So this is the return of investor. Now, say for example, the investor wants return of 10%. So if the mutual fund is giving return of 10%, should the investor make investment in that? The answer is no. Because if mutual fund is earning 10% of return, then there would be some expenses also. So after expenses, the return to the investor will be less than 10%. So how to calculate the expected mutual fund return? So you will consider what return you expect, 1 divided by 1 minus initial expenses. So you have to consider some initial expenses will be also there on the returns. So you will have to consider the returns after the initial expenses. So R1 divided by 1 minus initial expenses plus the recurring expenses. So the mutual fund should cover the recurring expenses and initial expenses to generate the return of 10% to the investor. So over here, say for example, all this expenses, considering all this expenses, the mutual fund is giving you 12% return, and after the expenses, the return to investor is 10%. So this 12% is the ideal return a mutual fund should earn, so to give the 10% return to their investor. So based on the returns of investor, what ideally mutual fund should earn considering the expenses, that is the calculation of return of mutual fund. So that would be R1 divided by 1 minus initial expenses plus recurring expenses. So initial expenses will be charged on the return percentage and you will add any recurring expenses to that. Then talking about effective yield of the mutual funds. So effective yield means this is like the annualized return. This is like annualized return. So if you are making investment in mutual funds, say for example, for 90 days, then what is your annual return you have to calculate? So you have to convert your 90 days return to the annual return. So say for example, you are earning 1 lakh rupees on investment of 10 lakh and this you have earned in 90 days. So what you would earn annual basis? So multiply 365 divided by 90. This will give you the effective yield, that is annualized return. So your yield will be your dividend plus capital gain, that is your income on mutual funds divided by the initial investment multiplied 365 divided by number of days. So this will give you the effective yield. The effective yield can also be calculated based on IRR method, but generally we don't make any calculation based on IRR method. We follow this formula also. This formula is simple to calculate. Then we have the evaluation. We will move to this part later. First, we will take up the questions based on this. Now, there is any other concept also as HPR, that is holding period return. So the returns you have earned for 90 days, that is 1 lakh divided by 10 lakh. This is your returns for 90 days. Return for 90 days. So this is called your holding period return and not the annualized return. So if you want to convert the effective yield to annualized yield, what you will do? So you can say that your HPR will be equal to effective yield into number of days divided by 365, because you have multiplied this to get the effective yield from HPR. This was your HPR, 1 lakh divided by 10 lakh. You have multiplied this to get the effective yield. So now you will multiply the inverse of this to convert the effective yield in HPR. And from HPR, if you want to calculate effective yield, so HPR into 365 divided by number of days, this will give you the effective yield. So always remember, the effective yield is the annualized return and the HPR is the holding period return. So this is the relation between the effective yield and HPR. Now we will move to the questions part. So this is all the type of questions being dealt in the mutual fund. We will take up step by step. So first we are taking up the question based on NAV. So this is all the formulas given to you: return of mutual fund, purchase price, public offer price, front end load, how to calculate front end load, back end load, how to calculate the returns, then NAV, then effective yield, IRR also you can use, then holding period return. So all this is the calculation. Then if you have the STT and short-term capital gain tax, then how would you calculate the returns? So you will have the redemption value, and on this you will deduct the STT from this. This will be the net amount you will receive, and you will have the capital tax on the profit. So you will calculate what is the profit, and on that you will have the tax calculation, and after tax you will deduct the investment. So this will give you the net gain or loss. So this is how you calculate if you have STT and short-term capital gain tax. So we are taking up the question number 7 first. Cinderella Mutual Fund has the following assets: Nairobi, Dakar, Senegal, Cairo. Number of shares, market price is given to you. Total number of units are 10 lakhs. The scheme has accrued expenses of 2,50,000 and other liabilities of 2 lakh. Calculate the NAV. So for investment, you have to consider the market value. So number of share multiplied by market price. Adding all these will give you the market value of investment plus you don't have any other expenses. So this is your total assets. If you add all this, will give you the total assets minus accrued expense of 2,50,000 minus other liabilities of 2 lakh. This will give you net assets. Dividing this by 10 lakh will give you the NAV per unit. So first you calculate the market value minus the liabilities from that, dividing it by units gives you the NAV. Then question number 10, a mutual fund made an issue of 10 lakh units at rupees 10. No entry load was charged. So this was the investment made from this. So they have issued 10 lakh units at rupees 10. So that means they have 100 lakh rupees, and from this 100 lakh rupees they have invested 98 lakh rupees. So 2 lakh will be available to them in cash. Now during the year, dividend of 12 lakh were received on equity shares, so your cash balance will increase with the dividend received. Then interest on all the debt was received as in when due, so you have the interest on all this received, so you will calculate the interest on all this, that is 7% of 8 lakh, 9% of 5 lakh, 10% of 5 lakh. At the end of year, equity shares and 10% debenture are quoted at 175% and 90% respectively of face value. So over here, other investment are at par. So the value of your 10% debenture and equity share will change. Now the value of equity share will be 175% of face value. So your face value is 100 rupees. So 175% of that will be 175. So the market value of your equity share at the end is 175. So 175 multiplied by number of equity shares will give you the market value of your equity shares. Then securities you will consider same 8 lakh and 5 lakh, but the value of debenture, 10% debenture will be 90%. So consider 90% of this 5 lakh will be the revised value of your debentures. Find out the NAV. Given that operating expenses paid during the year amounted to this, also find out the NAV if the mutual fund has distributed a dividend of rupees this per unit during the year. Now over here, you had this 2 lakh rupees as your cash balance. Then you also received the 12 lakh as dividend. So your cash balance will be of 14 lakh now. And from this, you have paid 5 lakh rupees as an expenses. So now your cash balance will be 9 lakh. So after this all investment, you will have the cash balance also. That is also your asset. So you should not miss out the adjustment of a cash balance. If you miss out that, then your calculation of NAV will be wrong. So you have to pay attention to calculation of the cash balance also. So over here, 100 minus 98, it was 2 lakh. Then you received dividend of 12 lakh. You received all this interest also. So we have missed out this interest. So we received all this interest minus expenses. So this is your net cash balance plus the value of all your investment. Now equity will be at a value of 175, debentures will be 90%, rest all will be at a par value. So this is your total assets divided by number of units, give you NAV per unit. Now if the mutual fund is distributing 0.8 per share, that is per unit, then your NAV will decrease by that amount. So your revised NAV will be 10.75, 11.55 minus 0.8, that will be 10.75. You can calculate this directly, or you can calculate it with the NAV also in total. So you will calculate, you have 10 lakh units, you are distributing 0.8. So multiply this, you will get the total dividend, and you will reduce this total dividend from the NAV. So this will give you the revised net assets divided by number of units, give you the revised NAV. So you can calculate it on the total basis also, or you can calculate it directly on the per unit basis also. Next, we are considering the question number 8, where you have to calculate the 2 days NAV. A mutual fund company has the following assets under it, that is LMNP. Number of shares are given to you, and this is the price on 1st February and this is on 2nd February. The number of units are 6 lakh. Calculate the NAV of a fund. So NAV will be number of shares multiplied by the market price. Adding all this, you will get the NAV, and divided by number of units, you will get the per unit. Now following information is given. Assuming one Mr. A submits a check of 30 lakh to a mutual fund and the fund manager of this company purchase 8,000 shares of M and the balance amount held in bank. In such case, what would be the position of a fund? Now over here, you have to consider that the investment is made on this 1st February and you have 30 lakh rupees. You got the 30 lakh rupees and from this they have purchased 8,000 shares of M. So M shares are value of 312.4. So 8,000 multiplied by 312.4. So this is the amount which is being invested. So 30 lakh minus this amount will give you the cash balance. So over here, the number of shares of M will increase. Now it will be 38,000. So over here, this is your simple calculation. Then for the revised position, your number of shares in M will be 38,000 at this value. So this will be your value of the investment, plus you will have the cash balance also. So this total will be your net assets divided by number of units. Now over here, you have to remember that the number of units will also change. Why the number of units will change? Because the investor, when the investor is making new investment, then your number of units will increase. So over here, this was your NAV on this date. So the investor will get the units at this rate. So you will calculate how many units will be issued. So 30 lakh divided by this NAV will give you the number of units issued. So total units will be 6,38,053. So you can calculate the per unit NAV also. Then you have to find the new NAV as on 2nd February. So over here on the 2nd February, you will consider this revised position. You will consider this revised position, but the prices, instead of 1st February, it will be the prices of 2nd February. So you have to consider the prices of 2nd February plus cash balance will remain same. So this will be the total assets value. Dividing it by number of units. So number of units will remain this only, will give you the NAV per unit on the 2nd February. Now the question number 12, you have to calculate the NAV based on regular income scheme. Now over here, based on the following information, determine the NAV per unit based on the regular income scheme. So you have listed shares, X dividend amount is given to you, cash in hand, bond debentures at cost. Of these bonds not listed and quoted are 1. So you have total investment of 4.3 crore in bonds, and from this 4.3 crore, 1 lakh is in unlisted and remaining 3.3 lakh is in listed bonds. Other fixed securities at cost is given to you, dividend accrued is given to you, amount payable on shares is given to you, expenditure accrued, number of units given to you, current realizable value of fixed income securities of face value of 100 is this. Now over here, you are given the realizable value of this fixed income securities. So this is your fixed income securities at cost and you are given with the market value of this. The listed shares were purchased when index was this and present index is this. The value of listed bonds and debentures at the NAV date is this. So the value of this listed bonds of 3.3, now the value of that is 8 crore. Now over here, you will not consider the change of this because this is a fixed income security. So the fixed income securities will remain at a cost only. So this is the adjustment for the regular income scheme, that fixed income securities will remain at a cost and you will take the change of all the other securities. So equity shares is 20 crore and you have purchased it at 1,000 value and now it is 23. So 20 divided by 1,000 into 2300, this will give you the current value of the equity share, that is 46. Then you will have the cash in hand, and from this bonds you have 1 lakh unlisted and 8 lakh value of your listed bonds. So this is your listed bonds, and you are given that there is a diminution of 20% in unlisted. So now this 1 lakh will reduce to 80 lakh because there is 20% diminution. So this will be 0.8 crore. So this is your total asset. Then you have amount payable and expenditure accrued. So this gives you net assets divided by number of units. You will get NAV per unit. So this is the adjustment, and you have to make the adjustments in this equity share, not listed and listed. All this will be adjusted, but this fixed income security will not be adjusted, as this is the valuation based on regular income scheme. Now we are considering a unique question, which is question number 13. This will use the concept of Sharpe ratio and Trenner ratio, which is the ratios analysis we have learned in the portfolio chapter. Now, similar, this Sharpe ratio and Trenner ratio can be used for the mutual fund also, because mutual fund is nothing but the portfolio. So for the mutual fund also, you can use the Sharpe ratio, Trenner ratio, and alpha for evaluating the mutual funds. So this was the next concept, that was Sharpe ratio. That is your excess return R minus RF divided by standard deviation. Sharpe means standard deviation. So higher will be better. Then in Trenner ratio, they consider only systematic risk. So you will consider the excess return divided by beta will give you the Trenner ratio. And Jensen alpha, that is your return minus expected return based on CAPM. So this will give you the alpha calculation. So your expected returns will be based on the benchmark. So what your benchmark returns are, what is your returns will give you the Jensen alpha. So in the practical life also, all these ratios informations are being calculated for mutual funds. So by comparing this, you can have the analysis of the risk in that mutual fund, and you can analyze the returns also. So we are taking up question number 13. There is two mutual funds, D and K, each having close-ended equity scheme. NAV on this of D is 70.71, consisting 99% equity and remaining cash value. Now we know that the NAV which we calculate includes the equity part also and the cash part also. So in this NAV, 99% is equity and 1% will be of the cash. And then for K, you have this NAV and 96% of this is equity and balance 4% will be cash. So over here, you will separate the NAV of equity and NAV of a cash. Now, why we separate this over here? Because over here, you are given with the Sharpe ratio and Trenner ratio. So you can calculate what will be the change in the returns of equity, and you will adjust this equity amount to the NAV of equity only. You will not make this adjustment to the total NAV, because it contains cash also, and cash will not be affected by the market. Cash will remain as it is unless and until you have incurred expenses from that, or you have received any other income in cash. So you can have the cash adjustment separately, and you will make the adjustments of equity in the NAV equity. So based on the changes, you will calculate the revised NAV of equity and NAV of cash, and adding that you will get the revised NAV. So this is a little new type of question. So you are given with the Sharpe, Trenner and standard deviation. There is no change in portfolio during the next month, and annual average cost is rupees 3 per unit of scheme. Annual average cost. Now this is your average annual cost, and you have to consider 12 months in a year and ignore number of days. you have to calculate the NAV after 1 month. So you have to consider the expenses per month. So 3 divided by 12 will give you the expenses per month. Now this will be adjusted in NAV of cash. And you are given that the share market goes down by 5% in 1 month. So it is not that D will also decrease by 5% and K will also decrease by 5%, because they cannot move in the with the same impact, because they will have different beta. So you want the beta which will give you the impact in the equity based on the change in market. So over here, using this Sharpe and Trenner ratio, so Sharpe ratio is your excess return divided by standard deviation. So you have standard deviation and Sharpe ratio, so you can calculate the excess return. And for Trenner ratio, you have excess return and Trenner ratio, so you can calculate the beta from this. So you will calculate this beta and you will apply this beta to the 5% to get what is the change in D mutual fund and K mutual fund. And you will apply this change to equity NAV. So first and foremost, you will separate the NAVs. So this is the NAV 99% and 1%, and this NAV 96% and 4%. So for D, this is your equity NAV, this is your cash. For K, this is your equity and this is your cash. Now you will calculate beta for D and K. So using Sharpe, you calculate excess return, and using Trainer, you calculate beta. So this is your beta. Applying this to 5%. So this will be 7.5%, and for K, there will be change of 5.5%. Now over here, the equity goes down. So whatever your equity will be, you will decrease your equity by this percentage. So this is your revised equity NAV. And for cash, you have to make the adjustment of expenses per month, that is 0.25. So that is 3 by 12. So you have to adjust the expenses from the cash. So this will be your revised cash NAV. Adding both this equity and cash revised NAV, you will get the total NAV after 1 month. So this is how you calculate the NAV after 1 month based on the Sharpe Trainer ratio, understanding what would be the impact of change in equity and cash NAV. Next, we are taking up question number 3, which is the returns of investor. A mutual fund has a NAV of 20 at the beginning of a month. Income and capital gain distributed are this per share during a month. The month ended with a NAV of 20.06. Calculate the monthly return. So over here, you don't have to calculate the annualized return. You just have to calculate your month return. That is your holding period return. So holding period return will be change in NAV plus income plus capital gain divided by NAV 0. This will give you the return. So the NAV has changed to 20.06 from 20. You have income of 0.0375 plus dividend of 0.03 divided by you have invested at the NAV of 20. So this will give you the return that is of 0.6375% per month. Now, if you want to calculate this annually, so you will multiply this with 12 to get the per annum basis. Now you have to calculate the return considering reinvestment. Question number 4, an investor purchased 300 units of a mutual fund at rate of 12.25%. 25 per unit on 31st December. On 31st December 2010, he has received this as dividend and this as a capital gain distribution per unit. You have to calculate the return of investment if the NAV is 13. So this is just simple. 13 minus 12.25 plus 1.25 plus 1 divided by 12.25. So this will give you the return for 1 year. You have invested from 30 December to 2010. The return on the investment on this, if all the dividends and capital distribution are reinvested into additional unit at a rate of 12.5. So over here, this 2.25 total income is not given to you in cash. but you are having the additional units on that. So you will calculate what units you will receive. So you are receiving 1 and 1.25. So over here, they have purchased 300 units. So over here, this is the total amount that will be reinvested, because you are receiving 2.25 per unit into 300 units. So you will receive 675 rupees. Now this will be reinvested at the rate of 12.5. So you will get additional 54 units. Now at the end, you will have 354 units, which will be redeemed at the value of 13. So over here, 13 was the value, that is the value on 4602. This will be the value, and price paid will be 300 into 12.25. That is, this is the price. So you will consider the difference divided by the investment amount. This gives you the return percentage. So this is how you calculate the returns considering the reinvestment. Now we are considering the question number 5th, where you have dividend reinvestment plan, bonus plan, and the growth plan. So over here, A is investing in dividend reinvestment, B in bonus, C in growth. And over here, this is for dividend reinvestment, this is for bonus plan, and this is for growth plan. And over here, Mr. Anand, Mr. Bachchan, and Mrs. Charu, they are investing 1 lakh each, choosing B, C, and A. So over here, Anand has choose bonus plan, Bachchan has chosen growth plan, and Mrs. Charu has selected the dividend reinvestment plan. So this is their selection. You are given with the information of dividend declared on various dates and the bonus ratio also. On 31st July, all three investors redeemed all the balance units. Calculate the annual rate of return to each of the investor. So over here, you have to calculate the annual rate. So you will calculate the return and multiply it with 365 divided by number of days of investment. So over here, you can consider it on the monthly basis to simplify. So you have made the investment over here on 1/4/1999 and you are redeeming on 31st July 2009. So from 1/4/99 to 31st July 2009. So from 99 to 2009 March, this will be 10 years. Then you will have extra 4 months also. So your total investment will be for 124 months. 10 years into 12 months, so 120 months plus 4 months. So your total investment period is 124 months. So over here, you are given that long-term capital gain is exempt, short-term gain is 10% of the income tax, STT is 0.2%, and you have to ignore the education cess. So first we calculate for the dividend reinvestment plan. So you have invested 1 lakh rupees at the NAV of 10. So you are not given with the base NAV, so you will assume it to be 10 rupees. So this was the value you have invested. So you got 10,000 units. Now this is dividend reinvestment. So on 28/7 you are receiving 20% of dividend. So 20% of dividend will be on the face value. So over here, the face value will always remain 10 rupees. So you will have the dividend of 20% on 1 lakh rupees, that is 20,000. Now this will be reinvested at the NAV in the dividend reinvestment plan. So considering 30.7. So this divided by 30.7, this gives you the number of units you will get on reinvestment. Now you have total units to be 10,651. So you will receive the dividend next time on this number of units. So what would be the face value? This multiplied by 10 will be your face value. You will consider 70% of this face value. So this is your dividend. Considering the reinvestment price, NAV, you get the number of units. So these are the number of units. So calculating all the dividends, at the end you have this number of units. Now at the end, the NAV for dividend reinvestment is 53.75. So you will get this amount on redemption. From this, there will be 0.2% of STT. So this is the net amount you will receive. So over here, you will calculate the gain. You have to consider the short-term capital gain. Now, short-term capital gain is for the securities you sell within 1 year. Now, you are selling entire investment on 31st 7 2009. So whatever units you have purchased from 1/8/2008 to 31st 7 2009, you will have the short-term capital gain on that. So in this period, you have only this date. So if you have any additional units on this date, then you have to pay STCG on that. So over here, you are getting how many number of units you are getting on this date. So on this date, you are getting this additional units. So you will calculate what is your gain on this units. So this is the units you got at this NAV, and the redemption NAV is 53.75. So you will take the difference of this. You will consider this 53.75, or you can adjust 0.2% on this. So this will give you the gain per unit, multiply it with the number of units you get. Taking 10% of that, you will get the short-term capital gain. Now you will calculate what will be the amount received after tax. So this is the amount received after tax minus investment will be your return. So this is your return in the dividend reinvestment. Now you have to calculate the annual return. So this is your total return on 1 lakh rupees in 124 months. So what will be the annual return? So it is 67.64%. Now we come for the bonus plan. So in bonus plan, you are having the bonus issue from time to time. So initially you had 10,000 units. Then the bonus was issued at 5:4. So you will calculate 10,000 into 5:4. So this will give you bonus units of 12,500. So the revised units will be 22,500. Then the bonus is issued 1:3. So now this 1:3 will be on 22,500. So 22,500 by 3 will give you the number of units. So total units will be 30,000. And then 30,000 divided by 4 will give you the bonus units on this date. So these are the total units at the end. Now, these are the total units which will be sell at this value. You will reduce the STT from this. Now over here, you have to calculate the short-term capital gain on this units. So for this units, you can either consider the NAV on that date to be your cost price, or you can consider your cost to be 0 because this is a bonus units. So you can calculate it either way. You can consider it 0 also, or you can consider this NAV also. So if you consider this NAV, then 10% of that will be this. So this will be your amount realized minus investment. This will be your return. So calculate the annual return. Then comes the growth plan. So in growth plan, there would be no dividend, no bonus. You invested and got 10,000 units at the start, and at the end also you will have 10,000 units. So there would be no short-term capital gain on the growth plan. So you will realize the value at 82.07, considering 0.2% of the STT on that. So this is your net amount received, no short-term capital gain tax. So minus investment gives you the gain. So over here, your total gain is 69.59% annually. So if you compare all these returns, there would be minor difference in all these returns. So in this, there is 67%, in bonus you have 73%, in growth you have 69%. So there is little bit difference in all the plans. You can select the plans according to the requirement of the investor. Now we are considering question number 6. The following information is extracted. The asset value at the beginning of a month is this. Annualized return is this. Distribution made in income and capital gain per unit is this. Calculate the month and NAV of a mutual fund. Limit your answer to the 2 decimal. Brief comment on the month and NAV. Now over here you are given directly with the return, but this is the annualized return. So over here you have been given the difference of NAVs. You have to consider for 1 month only. So this is at the beginning. Now we know that annual return will be equal to NAV difference plus capital gain and income divided by investment, that is NAV 0. This will be multiplied by 12 divided by 1. So this will be your annual return. So over here, this is your annualized return, and you have to calculate the month and NAV. So you can directly convert this annual return to the monthly return, or you can use this annual return for calculation. So over here, you know this NAV 0, you know this dividend capital gain, so you can calculate NAV 1 from this. So your NAV is 65.78. Initial NAV was also 65.78, and at the month also it is 65.78. So there is no change in the NAV. Now we are considering the question number 1, which is for the calculation of return on mutual funds. So Mr. A wants to earn 16% return, and they want to invest in a mutual fund which has initial expense of 5.5% and recurring expense of 1.5%. And how much should the mutual fund earn to provide Mr. A 16%? So what should be the return the mutual fund should earn to give 16% to investor? So that will be 16% divided by 1 minus 5.5%. So that will be this, plus recurring expenses of 1.5%. So this will give you 18.43. So if mutual fund earns 18.43%, then after tax expenses returns to the investor will be 16%. So this is the minimum return a mutual fund should earn to give the return of 16% to their investors. Now we are taking up question number 11, which is an important question, calculation of 3 years NAV. Mr. X on 1/7/2007, during the initial offer of some mutual fund, invested 10,000 units having face value of 10 for each unit. On 31st/3/2008, the dividend paid by mutual fund was 10%. Mr. X found the annualized yield of was 153.33%. On 31st/12/2009, 20% dividend was given. On 31st/3/2010, redeemed all the units 11,296.11 when annualized yield is 73.52. What are the NAVs on these dates? So you have to calculate, you are investing on 1/7/2007. You have to calculate the NAV on 31st/3/2008, 31st/3/2009, 31st/3/2010. So on 7th, you have purchased 10,000 units at the rate of 10 rupees. And in this year, 10% dividend is being given. And annual return is 153.33%. For this, you are given 20% dividend, and you are not given any other information. In this, you are given that number of units are 11296.11 units. Now over here, the number of units are increasing. So the number of units can increase only in the dividend reinvestment or the bonus. So over here, you are given with the dividend information, so it will be the dividend reinvestment plan. So these are the number of units, and annual return over here is 73.52%. Now from this to this, the investment is for 9 months. This is the investment for 12 months and this is the investment for other 12 months. So over here, the total investment will be for 9 plus 12 plus 12, that is 33 months. Total investment is for 33 months. Now you have to calculate the NAV for this year, and this year. So 3 years NAV you have to calculate. Now over here, annualized return is given to you, that is 153.33%. So you will convert this annualized return to the holding period return. So over here, your holding is for 9 months. So you will consider annual return, this annual return divided by 12 into 9. So this will give you the holding period return. Now we know that holding period return is NAV1 minus NAV0. So this will give you divided by NAV0. And over here, there is 10% dividend being given to you. So over here, 10% of this 1 lakh rupees will be 10,000 rupees. So 10,000 will be the dividend given to you. So what will be the number of units over here? So based on the NAV difference plus dividend. So dividend is your 1 rupees per unit because you have the face value to be 10. So dividend per unit will be 1 rupees. So adding the dividend to this will give you the holding period return, and based on that you can calculate the NAV. So your NAV in the first year is 20.5. Now this dividend of 10,000 rupees will be reinvested at this value. So 10,000 divided by 20.5, this will give you the number of units you will get in this year. So the number of units over here will be 10,000 divided by 20.5. So this is 487.8. So you have total number of units of 10,487.8. 10,487.8 at the end of this. Now, when in the next year 20% dividend is declared, so it will be on this units. So 10,487.8 multiplied by face value of rupees 10, face value is 10, into 20%. So this will be your dividend amount. Now over here, in the next year, no dividend is declared. So the number of units at the end of this year and in the next year will be same. So we know that the increase of this units is due to the dividend of 31st/3/2009. So you will calculate this difference of units. So this is the additional units. Additional units will be equal to dividend divided by the NAV. So you have the dividend amount, you calculated the additional units, so you will get the NAV. So this will be your NAV for the next year. So this is the additional units. Dividend per unit is 2. So total dividend is this divided by NAV gives you the NAV value. So that is 25.95. Now you have to calculate it for the third year. Now in the third year, you are given the annualized return to be 73.52%. So you will calculate the holding period return. So that is for 33 months. So you will convert this 33 divided by 12. So this is your annualized return converted to holding period return. So this is the percentage of return you have earned from 2007 to 2010. So your investment of 1 lakh rupees has increased by this. So this is the value of your investment now is 3,21,880 and you have 11,296.11 units. So taking the division of this, you will get the NAV. So based on holding period return, you calculate the value of investment and you get the NAV. You have number of units and you got the value of investment, so you get the NAV. So this is how you calculate the NAV for 3 years. Now, as such, student find it difficult, but there is no difficulty in this. Just you have to remember that you have to convert this annualized return to holding period return, and you have to take care for the reinvestments. So this is your calculation of 3-year NAV. Now there is similar question also, that is question number 8 in your extra question, and in that question you are directly given with the holding period return. So if you want, you can go through that question once. If you are directly given with the holding period return, then no need to convert that return. So you can directly apply that holding period return to get the NAV calculation. So this is your 3 years NAV question. Now we come to the returns calculation, annual returns calculation and effective yield calculation. So question number 9, on 1st 4 2012, ABC issued 20 lakh units at rupees 10. Initial expenses were 12 lakh. Invested the funds to build the capital portfolio of 185 lakh. In the month of April, disposed some security costing 60 for 63 lakh. So this is the capital gain, 3 lakh capital gain to the mutual fund. Proceeds were purchasing security of 56 lakh. The fund management expenses for month was 8 lakh, of which 10% was in arrears. In April 2012, the fund earned dividend amounting to 2 lakh and it distributed 80% of realized earnings. So they got this dividend, they have the capital gain also. So of this total earnings, they will distribute 80% of this earnings. On 31st 4 2012, the market value of portfolio is 198 lakh. Mr. Akash and investors subscribed to 100 units on 1/4/12, closing at 34 2012. What will be the annual rate of earning? So over here, when you issued, you have 200 lakh rupees. From this, 12 lakh was your expenses and you invested 185 lakh. So balance will be the cash available to you. So opening cash balance is your 3 lakhs. Plus you received 63 lakhs on sale and you have received 2 lakh as dividend. From this, you have purchased 56 lakh securities and you have expense of 8 lakh. But from this 8 lakh, only 90% of the expenses are paid. So in cash, you will take the adjustment of only 90% of the expenses. So 90% of 8, that is 7.2. And capital gain distributed will be, you have 3 lakh capital gain. From this, 80% are distributed. So 2.4 lakh are distributed. Then 80% of the dividend is also distributed. So this is your closing cash balance plus the market value of investment will give you the total asset value minus arrears of expense. Now don't forget to decrease this area of expense. 10% of this 8 rupees are accrued expenses. So 0.8 you should reduce this. So you get 198 lakh as your net assets divided by number of units, you get closing NAV. So this is your closing NAV. Opening NAV was 10. So over here, there is decrease in NAV and you have received this income. Now this total income is in lakhs. So you will convert this total income per unit. So this is your 4 lakhs rupees distributed on 20 lakh units. So that will be equal to 0.2 per unit. And you have loss of 0.1, that is 10 minus 9.9. So this is your loss and this is your gain. So you had net earnings of 0.10 and your initial investment was at rupees 10. So you get 1% to be your rate of return for monthly. Converting this to annually, you have 12% return per annum. Next, we are considering question number 14. The following particulars related to S fund scheme is given to you. Investment in shares value is given to you. Bond listed and unlisted bonds. Number of units are given to you. Expense payable, cash equivalent, market expectation on listed bonds. The fund has incurred the following expenses, particular related to each sector. Index purchase date and index valuation date is given to you. You have to calculate the NAV of a fund, NAV per unit, and net return annualized if the period under consideration is 4 years and the fund has distributed 2 per unit as a cash dividend. So this part we will consider later. First we calculate the NAV part. So over here you are given on the valuation date, you have index values and on the purchase date. So what you will do, so this 158 multiply by 500 divided by 300. So valuation index divided by purchase index. So based on this, you will calculate the revised value of the shares. Then for bonds, you are given that the market expectation on listed bond is 8.842%. Now, the value of this 24 crore is based on this expectation. So what should be the value for your 14%? So this 24 is for 8.842. So what should be the value for 14? So 24 multiplied by 14 divided by 8.842. So this will give you the revised value of the listed bonds. Earlierly, there was the adjustment given to us, but for the fixed income securities, but we ignored that because in the regular scheme, we don't consider the change in the fixed income security. But over here, there are listed bonds and you are given with the adjustments for the listed bonds. So you will make this adjustment. Unlisted bond will be at the cost and you have expense this payable and this is your cash balance. So considering all the market value of the assets, listed bonds revised, unlisted bond the same price, add cash minus expense payable will give you the net assets. Now this net assets divided by number of units gives you the NAV per unit. Now over here you are given that you have to calculate the net return considering the period of 4 years. So this is the position before 4 years and you have calculated this revised position after 4 years. So over here you want the initial NAV also. So based on this given information, you will calculate the NAV, that is the initial NAV. But in that, you will not consider this expense payable because this is for the current year. So you will not consider this. So you will just consider the investment and bonds. You will not consider the cash and expenses payable because that is the balance for now. You will not consider this. So your investment in shares is total of this and plus bonds is this. So this is your total NAV at the beginning. So over here, this is your investment. This is your total NAV at the beginning. So this is 458 crores. And the number of units are 8.4. So this is your cost per unit. Now you are given the adjustment that the fund has distributed rupees 2 per unit per year as a cash dividend. So over here, 2 rupees per year, that means multiply by 4. So 8 rupees total dividend is being distributed per unit. So you will take up this dividend and you will consider the capital gain. So capital gain will be, this is your NAV now, and this was the opening NAV. So this is your NAV difference plus dividend received this. So this is your total receipt on investment of this for 4 years. So multiplying it by 1 by 4 gives you the annual return. That is 21.31%. So this calculation part is to be understood, that you have to calculate the opening NAV based on the opening position and consider what will be the dividend for 4 years, and based on that you will calculate the annual return, that is your 21.31%. Now we come to question number 15. A has invested in mutual fund scheme ABC. Date of investment, amount invested, NAV is given, dividend received, NAV at the end is given to you. You have to calculate the effective yield on the per annum basis in respect of all the three up to 31st/3/2010. Now the investment is on the separate dates. So you will have to consider the number of days for each and every mutual fund. So from 1/4/2009 to 31st/3/2010, you will calculate the number of days in each. Now, this is the amount of investment. Dividing it by the NAV, you will get the number of units. So this is your number of units, and NAV at the end is this. So you will get the value at the end. So you can calculate what is the difference between the NAVs plus this dividend amount will give you the total yield. So total yield is your increase or decrease in NAV plus the dividend received. So this is your total yield. Now the total yield divided by investment amount into 365 divided by number of days into 100 will give you the effective yield. So in this, your number of days are 121, this 90, this 31. So you will calculate the effective yield for each case, considering what was your investment amount and what is your yield. So this is your yield on this investment amounts, and multiply it with 365 divided by the number of days, you will get the effective yield per annum. With this, you can easily compare all the mutual funds. Now we are taking up question number 17, effective yield per annum for dividend and bonus plan. The mutual fund company introduced two schemes, dividend and bonus. NAV 10, invested 2 lakh each in D and B when the NAV was this and this. Respectively, both the plans matured on 31st/3/2010. So they have made the investment for 5 years from 1/4/2005 to 31st/3/2010. So the investment is made for 5 years, and you have to consider what is the effective yield in about two plans. So first you will calculate for dividend plan, then for bonus plan. The investment made is 2 lakh rupees, and the purchase price is this. So 2 lakh divided by this will give you the opening number of units. So this is the opening units, multiply by the face value into dividend percentage gives you the dividend amount. Consider what is the reinvestment rate. So by calculating the reinvestment, you get the total number of units at the end to be 5.92. Now this will be matured at the price NAV of 40.4. So this is your maturity value minus cost. This is your return. Now this return divided by the investment amount of 2 lakh multiplied by 1 by 5, because you need the annual return. This is the return for 5 years. So this will be your annual return. You can calculate this based on IRR also, but we just calculate it simply with the effective yield formula. Then for B, you will calculate the number of initial units, then calculate the bonus units. These are the total units will be redeemed at this. Less investment gives you the gain, and similarly you calculate the effective yield for the bonus also. Now we take up the question number 18, where you have to calculate the issue price. So this is the reverse calculation. over here on 1/4/2015 they have floated two schemes. You are not given with the opening NAV, you are given with the dividend and bonus. Additional detail investment amount is given to you, average profit is given to you, and average yield in percentage is given to you. You are required to calculate the issue price of both the schemes. So over here, first we calculate about the dividend plan. So in this, you have made investment of 9,20,000 and you have profit of 27,748.6. Now this is your average profit. So average profit, that means this is per year and you are considering the investment from 15 to 20. So you will multiply this with 5 to get the total profit. So this average profit multiply by 5 to get the total profit. So this is the total profit plus initial investment amount will give you the value of investment at the end. Divide it by the NAV, you will get the number of units. So you have the NAV at the end, so you will get the number of units. So these are the number of units at the end. Now you have to start from end and get to the opening units. And once you get the opening units, you will calculate the NAV based on the investment amount. So over here, 21,607. Now the rate of dividend is 15%. Unit value is 10. So per unit, your dividend will be 1.5. And NAV on this date is 45. So you will start from reverse. Over here, your calculation will be made in inverse way. So you start with this and this. So at the rate of 45, the number of units you will calculate the new units and the balance units will be the opening units. So over here, you are having the dividend of this, dividing it with the NAV, you get the new units. So over here, how you will get this new units? This will be like closing units are equal to opening plus new invested. So new invested will be over here. New invested will be dividend divided by NAV. So now this will be opening units plus dividend will be opening units into 1.5 divided by NAV. You have the NAV that is 45. So you will make this calculation and calculate the opening units from this. So you will get the opening units and these are your new units. So next, this opening units will be the closing units of the previous year. Then you will again take up this revised calculation and calculate the new units and balance unit. Similarly for the starting part. So this is the initial units, that is 20,000, and your initial investment is 9,20,000. So 9,20,000 divided by 20,000, you will get the NAV that is 46 per unit. Then you will similarly get it for bonus plan. In bonus plan, you are given the annual yield in percentage and you will consider you have investment of 10 lakh. So you will consider the investment percentage for 5 years. So you will consider multiply this with 5 to get the 5 years gain. So this will be the market value at the end. You are given with the closing NAV. So this will be your closing units. And now you will consider the reverse calculation in the bonus plan also. So the ratio is opening units plus opening into 1/5 will be equal to closing. Now you have this closing and you have to calculate this opening. So you will calculate this opening from this, and you will get this opening units to be 25,000, then 20,000. So initially you have 20,000. So your investment in this was 10 lakh divided by 20,000. You get your NAV to be 50. So this is how you make the reverse calculation from the closing NAV, closing units. You get the opening units, and from opening units with the investment, you get the opening NAV. Now we are taking up the question number 3 in your amendment book. A mutual fund has NFO on 1/1/2021, 10 lakh units, 10 each, no entry load. This were the equity share purchased. This is all the investment. During the year, dividend was 8 lakh received on equity shares. Interest for all were received on 31st December. Equity share appreciated by 15%. Listed debenture quoted at 20%. XYZ on 15th December in its AGM declared the interim dividend of 10% and bonus share of 1:10 with the record date of 28th December. Find out the NAV per unit on 31st December given that the operating expenses during the year amounting to 3 lakh. Now over here, the value of the equity share has appreciated by 15%. So earlier it was 320, now it will be 320 plus 15%, and listed debentures are quoted at 20% premium. So you will have the revised value of equity and debentures and take this government security and NCDs at the cost book price only. So first you will calculate what will be your opening cash balance. You received 100 lakh rupees. From this you have made this investment. So this is your 1 lakh is your cash balance. You received 8 lakh dividend plus you received interest, and you have declared the interim dividend of 10%. So you will calculate the dividend of 10% minus operating expenses. You are given that 3 lakh for operating expenses. So this will give you the net cash balance. You will take this cash balance and the revised value of all the investment. This will give you total assets divided by number of units. You get NAV per unit. Then you have distributed 0.5 per unit. So NAV will be 13.22 minus 0.5. This will give you the NAV of 12.72. If you are an investor, find out what is the annualized return you have got. So you can calculate in the first way or in the second way. So in the first way, your NAV is 13.22. So if you consider 13.22, then minus 10 divided by 10 gives you the return. But if you are considering this 12.72, then you also have to consider the dividend received per unit, that is of 0.5. to calculate the return. So this is the important point you should remember. If you are considering 12.7, you have to consider dividend also. But if you are considering 13.22, then you can directly calculate the return. Now the question number 16, Mr. Y has invested in 3 mutual funds. Net asset value is given to you at purchase. Dividend, NAV, effective yield per annum is given to you. Assuming 365 days, you have to calculate number of units, NAV, total yield, and number of days investment held. So over here, first you will calculate from this effective yield. This is your amount of investment. This is your NAV at the purchase. So you will get the number of units, and this is your closing NAV, and this is your dividend received. So you will get the total yield in amount. So this is your total yield in amount, and you know the investment, and you also know the effective yield. So from this you will get the number of days. Now from this number of days, by calculating back calculation, you will calculate the date of investment. So this is your date of investment for the, so you got the number of units, you got the total NAV, you got total yield and the number of days of investment. So this is your entire calculation. Now we are taking up question number 2 in your amendment book. Mr. D has invested in 3 mutual funds as per the following details are given to you. Amount of investment, NAV, dividend, NAV, annualized yield. Assume 1 year to be 365 days. Mr. D has misplaced the documents. You have to calculate the number of units allocated in each scheme. So amount of investment divided by NAV gives you the number of units. Value of investment on 31st/3/2022. So this number of units multiplied by NAV gives you the value plus the dividend received. So you will add the dividend percentage also. So this is your value of investment. Then you will calculate the yield. That is your value of investment minus the initial investment will give you the capital yield plus dividend gives you the total yield. Now you will calculate this yield in percentage. So over here you can calculate this yield in percentage. So you have to calculate the holding period of the investment in number of days. So over here you have the annualized return. You have the annualized return and this is the yield you have earned. So this is your holding period return. So we know that effective yield is equal to holding period return into 365 divided by number of days. So you will consider this and get the number of days. So your number of days are 300, 124 and 195. So taking up the back calculation, you can get the date of investment. Then you have to calculate the total return on investment. Total return on investment means you have made total investment of this, that is 11 lakh, and this is the total return you have, that is 29,000. So 29,000 divided by 11 lakh, you have a total yield of 2.636%. Then assuming the past performance will continue for next 1 year, what action should the investor take? What will be the expected return for next 1 year after the above action? Now over here, the mutual fund A, if you consider the return given to you, this is the annualized return. Now the comparison can only be made based on the annualized return. So this is your annualized return and you have got the number of days. 300, 124, 195. 300, 124, 195. So over here, in this you are earning less return by investing for more time. In this you are earning little more return for investing less time, and over here you are earning the maximum return and for investing 195 days. So this is the best investment. So you can sell the mutual fund A and B units and purchase the C units. So if you take this action, then your return will be 15% per annum. Will your answer as the above changes if the mutual fund charges exit load of 5% if the investment is redeemed within 1 year? Advise the investor what and when the return should be optimized. So over here, if you see the holding period return, then you have negative return in B. So you should not make investment in B at any cost, even though there is exit charge. But you are having 8% return in A also and in C also. And there are 300 days already being completed in A. So you should hold the investment for other 65 days also to not get the exit load. So you will not be charged with the exit load, and after 365 days you can sell the mutual fund A units also, and you should sell the mutual fund B units now only, even though there is exit load, because this mutual fund is giving you the negative returns. So you should sell the mutual fund B units and invest proceeds in C and sell the units of A after 65 days. Now we are considering the question number 7 in your amendment book. Mr. S has invested in 3 different mutual fund scheme. Date of investment, NAV entry, dividend unit NAV is given, increase decrease in NAV is given to you. Effective rate of yield per annum is given. Ignore entry exit load. Assume this, round off the investment to nearest 100. You are required to calculate the amount of invest made initially, number of unit invested in 3 schemes. So over here, you are given the NAV at the entry date, but you are not given with the amount or units, opening units or opening investment. So over here, you will calculate it based on the effective yield. You are given with the increase and decrease, you are given with the dividend amount. So you will add this and get the total yield. Now, once you get the total yield, dividing it by the investment amount, multiply by the 365 divided by number of days, you get the effective yield. So you are given with the effective yield. From that, you will calculate the initial investment amount. So initial investment amount, you got this to be your initial investment amount, and dividing it by the opening NAV, you get the number of units also. So just you have to apply the formula and find what the balance information you need. Advise also whether he can continue to hold his investment or they can redeem now. So over here, they should consider A and B, they are giving you the positive return, but C is giving you the negative return. So they should redeem from the C now. So this is our calculation of investment amounts, opening NAVs also. Now we come to the question of calculating the entry load. Question number 24. During the year 2017, an investor invested in mutual fund. Capital gain and dividend is 3 per unit, which were reinvested at the year-end NAV of 23.7. Total units are this. NAV appreciated by this during the year. Entry load is this at the time of investment. Investor lost its record. Calculate the investment made and entry load. Now, you have capital gain and dividend of 3 per unit, which are reinvested at the rate of 23.75. Now this 3 per unit, but you don't have the total opening units. So this will be 3 into opening units plus opening units. This total is equal to number of units of 26,750. So you will get the opening units. Now, once you get the opening units, you have to calculate the opening NAV. Now, the NAV has appreciated by 18.75%. So, your opening NAV plus 18.75% is equal to closing NAV. Now, the closing NAV is given to you, that is 23.75. So, you will get the opening NAV. So, over here, this is your number of units and you have to calculate the opening NAV. So this is your opening NAV, that is 20. Now you have entry load of 0.05. So the purchase price will be 20 plus 0.05, that is 20.05. So you have to find the investment made. So you have the number of units, opening number of units, multiply by 20.05 gives you the total investment amount. And if you have to calculate the entry load, so number of units multiplied by 0.05, you calculate the entry load you have paid on the investment. So this is how you calculate the entry load on and investment amount. Now we take up the question number 5 in your amendment book. The Asset Management Company Mutual Fund declared a dividend of 9.98% under the dividend reinvestment. The investor issued additional units at a closing NAV. Closing NAV is this. Investor has 20,800 units at the end and you have to calculate the opening and entry load is 0.04 NAV appreciated by 25%, face value is 10. So this is the similar question we have done now. So over here, you have 9.98% dividend declare. So your opening units into 10, this face value, multiply by 9.98%. This will be the dividend reinvested at the closing price of 24.95 plus opening units will be total equal to 20,800. So you will get the opening units from this. Then now the opening NAV plus the appreciation of 25% is equal to closing NAV. Now you know the closing NAV to be 24.95. So you will get the opening NAV also. So this is your opening NAV. You got the opening NAV and the opening units. So you will multiply this. You will calculate the purchase price, that will be 20 opening NAV plus 0.04. That is your entry load. So your purchase price is 20 rupees multiplied by number of units. Total amount invested is 4 lakh rupees. Now we take up the question number 4 in your amendment book. Messrs. Strong and AMC has floated a dividend bonus plan, and the fund has robust growth, declared the bonus of 1:5 on 30 September and second bonus of 1:4 on 30 September 2019. The fund as on 31st March 2021 has generated the average yield of 17.5. So you have made investment on fund for 2016 and you are considering now on 31st 3 2021. So this is the investment period of 5 years. An optimist has made an investment of 16 lakh in the plan before declaration of first bonus and remain invested thereafter. You have to calculate the opening NAV. So over here, you are given that on 30 September 2017, over here the bonus was issued at 1:5 and second bonus was on 30 September 2019, that was 1:4. So over here, first, based on this average yield, you will calculate what is the value of investment now. So you have invested 16 lakh. This is your average yield. Multiply this with the 5. So you will get the total investment value now. So this is your total investment value. Dividing it by the closing NAV, you will get the closing units. So again, you will take the back calculation of 1:4 bonus first, then for 1:5 bonus. So you will get the opening units. Opening units, you have got the opening units. You have invested 16 lakh. So 16 lakh divided by units, you will get the NAV. Then we have the question number 2, calculating the front end and back end load. So over here, the scheme has 10 rupees of a unit price. Public offer price is 10.204 and redemption is 9.8. You have to calculate front and back end load. Now the first way is just calculate the difference and take it divide by the NAV. So that will give you the percentage. So 10.0204 minus 10 divided by 10, this gives you the percentage. So in front end load, you will consider public offer price minus NAV because public offer price is higher. But for back end load, you will consider NAV minus redemption price because NAV will be higher. So 10 minus 9.8 divided by 10 gives you the percentage. Now this is the simple way to calculate, but you have this formula also. Using this formula also you can calculate, that is public offer price is equal to NAV divided by 1 minus front end and redemption is NAV divided by 1 plus back end load. So in this, we are considering that NAV is inclusive of the front end and back end. So based on that, you will have the different percentage. So ICI has both the solution given to you, both the formulas can be used. So whichever formula seems convenient and you can remember that formula, you can use that formula. So this is the calculation of front end and back end load. Now we are considering the question based on the fee payable, which is a unique type of question. Now, the fee payable can be of two types. The first one is which is paid on the total assets, that is a fixed fee. Then there could be an incentive fee. Now, the incentive fee is paid when the mutual fund manager has reached to a value which is greater than the expected value. Now, what will be the expected value? Expected value will be the maximum value the fund has achieved till now. So, what the fund has achieved till now, that would be the benchmark value. What excess you have earned from that, you will get the commission, that is incentive fee on that excess earned. So this is the way to calculate the fee. So we will take up the question number 22. ANP plan, a hedge fund, currently has assets of 20 crore. CAX, the manager of fund, charges 0.10% of portfolio asset. In addition, 2% incentive linked to gross return each year in excess of portfolio maximum value since inception. And since inception, it was 21 crores. So you have the benchmark value of 21 crores. Whenever your fund value is more than 21 crore, then you will have the incentive fee of 2% on the excess value. So first you will consider that you have return of 29%. So your assets are 20%. So considering 29% on that, your total value of fund will be 25.8. Now this is more than 21%. So you will take the difference of this, that is 4.8 crore. This is the excess value. 2% of this excess value will be paid as incentive fee plus the fixed fee of 0.10% on 20 crore. So this is your fixed fee, that is 2 lakh rupees. This will be paid irrespective of whatever the return is. So this is the total fee paid to the manager. Then if your return are 4.5, then you will calculate what is the value of the fund. So value of fund is 20.9, so which is less than 21 crore. So over here, no incentive fee will be paid, only the fixed fee will be paid, that is 2 lakh. And whenever the return are negative, no question of incentive fee, you will just pay only the fixed fee. So this is how you calculate the fee for the manager based on the returns. Then we are considering question number 25. This is also a little unique question. Mr. Alex, a practicing chartered accountant, can earn the return of 15% by investing equity share by own. He is considering recently announced equity-based mutual fund. Initial expenses are 6%, annual recurring are 2%. What should he expect from the mutual fund to get the return of 15%? So you will calculate the return of mutual fund, that is they should earn 15% divided by 1 minus initial expenses, that is 0.06 plus 2% of recurring expenses. So you will get the returns of mutual fund should be 17.96%. Now the second part, Mr. Alex current professional income is 40 lakh, portfolio value is 50 lakh. Now he is spending 10% of his time to manage his portfolio. If he spend this time on profession, his professional income will go up in the same proportion. So if he invest 10% more time in the profession, he will earn more 10%. He is thinking to invest entire portfolio in NAV growing at 13%. So if we invest by himself, then he can earn 15%. But if we invest in mutual fund, he will earn 13%, but he will have additional professional income. So you will calculate what will be the benefit in both the scenario and which will be the most beneficial option. So in the first case, he has professional income of 40 lakh and on the portfolio of 50 lakh, he is earning 15%. So this is the total income, that is 47.5. In the second scenario, he will have the additional professional income of 10% of 40, that is 44 will be the professional income. And on portfolio of 50 lakh, he will earn 13%. That is 6.5. So total is 50.5. So even though the mutual fund is giving them less return, but they can earn more by investing that time in the profession. So they should consider to make investment in mutual fund than making investment by themselves. This will give you the net benefit of 3 lakh rupees. So we have taken up the question based on NAV, 2 days NAV, 3 days NAV, regular income scheme NAV, equity cash NAV. Then we calculated the effective annualized yield, reverse calculation from that, reverse calculation, calculating investment amount, opening NAV, entry load, exit load, fee payable, investment planning. So this part is done. Now we have 3 more part, that is dividend, equalization, reserve, then evaluation and rebalancing. So in evaluation, there is some addition in the theoretical part, and the practical part of evaluation consists of Sharpe, Trenner and Jensen alpha. That is same as we have learned in portfolio, and rebalancing methods are also same as we have learned in portfolio, because mutual fund is nothing but a portfolio. So you can apply the concepts of the portfolio to the mutual fund as it is. So this is, we will take up later. First, we will understand what is the dividend equalization reserve. Now, this is a very important topic, dividend equalization reserve. Now, what is this and what is the need of this? First, we will understand that. Then we will go into the calculation part. So, what is the dividend equalization reserve? Whenever consider this relating to the partnership concept. So whenever there is new partner incoming, this incoming partner have to bring the share of profits. Now, why they have to bring the share of profits? Say for example, this incoming partner has incoming on 1st April. Now, if we consider the calendar year, we are not considering the financial year over here. For simplicity, we are considering the calendar year. So from 1st January to 31st March, whatever profits you have earned, the new incoming partner should not get the share from this profit. So over here, at the end, when you distribute the profit in the ratio, say for example, they have equal ratio though. So now there are 2 partners, the ratio is 1:1. And then the ratio will be 1:1:1 for 3 partners. So at the end, when you distribute these profits, so for this 3 months, only A and B should get the profits, C should not get the profits. So when you divide these profits equally, then C is also getting the profits from this 3 months, which he was not entitled to. So whenever there is incoming of a partner, he has to bring the share of profits up to now. So what are the profits till now? He has to bring 1/3 of that, his share in that, so that the profits can be distributed equally at the end. This is the concept based on the partnership, which we all know. Similarly, whenever there is retiring partner, so he is eligible to get that returns. So instead of incoming, consider there is a partner who is retiring on 1/4, then he is eligible to get the profits for this 3 months. So you have to pay the profits, the share of profits to the retiring partner, and at the end, now this share of profit will be borne by A and B, and at the end, the distribution of profit will be made equally to A and B. So this is the working of the profit equalization. So over here, when you want to distribute profit equally or in some ratio, then you have to take care while incoming and retiring. Similarly, is for the mutual funds. So in mutual funds also, whenever the mutual fund is declaring the dividend, now some unit holders may not be entitled to get the dividend which was for the previous year. So they have to bring the dividend equalization reserve. So their purchase price will be opening NAV plus dividend equalization reserve or any entry load also. And at the time of exit, the closing NAV minus exit load plus dividend equalization reserve. So the mutual fund has to pay the dividend equalization reserve to the retiring unit holders to distribute the dividend equally at the end. So over here, to not make the process of dividend distribution complex, so mutual fund will not calculate for each and every unit holder that this unit holder was available for this period, so I should give only this amount of dividend to them and this amount of dividend to B, this amount of dividend to C. So they cannot calculate this for individual unit holders. There would be n number of unit holders. So to equalize the dividend for each and every unit holder, they will charge the dividend equalization reserve. So I hope you understood the topic of the dividend equalization reserve. Now we will understand how to take up the question of that. So we know that the issue price and redemption price. So question number 19, on 1st April, an open-ended scheme of mutual fund had 300 lakh units outstanding with NAV of 18.75. At the end of April, it issued 6 lakh units at the opening NAV plus 2% load adjusted for dividend equalization. At the end, 3 lakh units were repurchased, opening NAV less 2% exit load adjusted for dividend equalization. At the end of June, 70% of income available was distributed. Now, you are starting from April to June. So at the end of April, you are issuing new units. So the new units should not be entitled for the profit of April, for the profit income of April. So you have the income of April, that is 22.95. This income should be given only to 300 unit holders. So 300 lakh units were there. Now you are issuing new 6 lakh units. So you will calculate per unit this amount of income per unit and you will charge this income per unit as a dividend equalization reserve. So 6 lakh units will have to pay this amount. So now you will have total amount this and total units will be 306. So per unit remains same because you have charged this income from the new unit holders. Now in May, you have income of 34.425 and you are given that at the end of May, 3 lakh units were repurchased. So these units are repurchased. So you have to pay the dividend equalization reserve to them. So they are entitled for this May also. This is up to April, adding May in this. So they are entitled to get this amount when they are retiring. So you will pay this dividend equalization reserve on 3 lakh units. So you will decrease your income. So this will be your income on 303 lakh units because this is your repurchase. Per unit will remain same. Now you will add the income of June. So this is your total income per unit. And from this, you will distribute 70% of this. So reducing that, you will have this as a net last income. So this is how you calculate it. So in your 6 lakh, this will be your dividend equalization reserve. In 3 lakh, this will be your dividend equalization reserve. So your issue price will be the NAV, opening NAV plus 2% load. So opening NAV is 18.75 plus 2% of load plus this dividend equalization. So you will get this as your issue price. Then you will calculate the repurchase price also. Opening NAV minus exit load plus dividend equalization. So this is your repurchase price for 3 lakh units, and this is your issue price for 6 lakh units. So now you will calculate the closing NAV. So opening NAV multiplied by number of units. So this was the total amount available to you. Portfolio appreciation is of this. You have issued 6 lakh units at the value of this. So this is the amount you got, plus you have received income for 3 months, and you repurchase the units at this rate. So this will be minus, and you have distributed this income. So you will deduct this also. So you will get the NAV. Now this is the NAV for 303 lakh. So closing NAV is 20.2670. So this is how the dividend equalization reserve is being adjusted with the issue price and repurchase price, and accordingly you calculate the closing NAV. So next is the question based on the portfolio evaluation considering Sharpe, Jensen and Trenner. So you have 7-year period average return, standard deviation, correlation given to you, market risk, market return, RF given to you. You have to calculate Sharpe ratio, Trenner and Jensen alpha. So over here, you are given with the average annual returns. So annual returns minus RF divided by the standard deviation is already given to you. So you can calculate the Sharpe ratio. Then for Trenner ratio, you need the beta. So beta is not available to you. So you can calculate the beta as standard deviation of security divided by standard deviation of market into correlation. So you have correlation, you have standard deviation of market, you have standard deviation of security. So you will calculate the beta for each and every security and then calculate R minus RF divided by beta for Trenner. Then you have to calculate the Jensen alpha. So you have the beta for each and every security. So you will calculate the CAPM return for each and every security and take the difference of the actual return minus the expected return of CAPM and get the Jensen alpha. So this is the calculation of Sharpe, Trenner and Jensen alpha. Now you have to rank. So ranking will be from high to low always. For all the ratios, Sharpe, Trenner and Jensen alpha, the ranking will be from high to low. Then question number 21, you are given with the average return variance coefficient of determination. The yield on 182 days treasury bill is 9%. So this is your RF. Rank Sharpe, Trenner. Compare the performance with the market. So first you have to calculate the Sharpe. So over here you are given with the variance. So you will calculate the standard deviation, that is under root of variance. So you will consider R minus RF divided by standard deviation. Then you need beta. So over here, the variance of market is given to you. So you will calculate the standard deviation of market and determination, coefficient of determination is given to you. So this is R square. So you will calculate R, that is under root of this. So you will get the beta, that is standard deviation of security, standard deviation of market into correlation. So you will get beta and then you will calculate the Trenner ratio. Then you have to compare the performance with the market. So over here, you will calculate the Sharpe and Trenner ratio for market also. So for market, that would be 0 because your market is also giving you 9% return and the risk-free rate is also 9%. And we know the beta of market is always 1, so this will be 0 and you are given with the standard deviation, so this is also 0. Now, if you compare the Sharpe ratio, so Sharpe ratio is negative in all the funds. So as per this Sharpe ratio, your funds are not performing good than market because in market your ratio is 0 and your ratio, your mutual funds ratio are less than 0. So that is the poor ratios. So they are performing negatively and with the comparison of market, they are performing poor. Similarly, also for Trenner, they have negative ratios. Now we take up the question number 1 in your amendment book. You are given with the mutual funds written for 3 years, correlation, variance of market and RF. You have to calculate Sharpe and Trenner. So first you will calculate the average return. So this plus this plus this divided by 3 will give you the average return. Then you will consider this average return minus RF divided by the standard deviation for Sharpe ratio and divided by beta for the Trenner ratio. So over here, the standard deviation is not given to you. So you have to calculate the standard deviation. So you will consider this x minus x bar whole square divided by n. So this you will calculate for mutual fund A, B and C. So this is your standard deviation. You will calculate the Sharpe ratio and you will calculate the beta. So standard deviation of security divided by standard deviation of market multiplied by R gives you the beta, and you can calculate the Trenner ratio, then rank from high to low. So this part is simple. Now we take up the question number 23, which is our last question considering the constant ratio plan. So over here you have to consider the rebalancing considering the constant mix. So over here Mrs. Sunedi as working in MNC, she is well versed with the portfolio management techniques and they want to compare the passive buy and hold. The funds consist of the following NAVs for last 10 months. Assume they have invested 2 lakh equally in equity, conservative and a conservative portfolio of bonds. Beginning in December 2000, the total portfolio rebalance each time at the NAV increase or decrease by 15%. So first you will consider the NAV 40 and you have invested 1 lakh rupees. So you have invested notional amount of 2 lakh equally in this equity and conservative. So 1 lakh and 1 lakh in conservative and aggressive. So total value is 2 lakh. And number of units in aggressive will be 1 lakh divided by the NAV 40. So this will be the number of units you will have. Then now NAV comes to 25. Now when you decrease 40 minus 15%, you will get the value to be 30. So this is less than 30. When there is decrease and this is less than 30, then you have to rebalance. So you have to rebalance over here. So if you consider this 40 minus 25 divided by 40, then this is 37.5%, which is more than 30%. So you have to rebalance. Now the 22,500 units will have the NAV of 25. So this will be the value of your aggressive plus conservative will remain same. So this is the total portfolio value. Now this will be considered equally in both. So you have to consider this. So you will have to increase the amount in aggressive. So you have to buy the units. So over here, what increase you have to make? So you will consider 81250 minus 62500. So this is 18,750. You have to make additional investment of this and this will be made at the rate of 25. So this divided by 25 gives you number of units of 750. So now you have total units of 3250. Then when the rate is 36, so from 25 to 36, what is the percentage change? 36 minus 25 divided by 25. This is 44%. So this is more than 15%. So over here, you will again rebalance. So 3250 multiplied by 36. This is the value of aggressive. This is for conservative. Total is this. Taking equal. So this will be the value. So over here, you have to reduce. So you will consider what amount you have to reduce divided by NAV gives you the number of units you will sell. And this gives you the revised number of units. Then 32. Now this difference is within 15%. So no rebalancing. So taking this multiply by 32, this will be the portfolio aggressive plus conservative remains same. So this is the value. Then 38, this is more than 15%. So again rebalance. So 275, 3 units multiply 38. This is the value of aggressive plus conservative. This is the total value. Considering equal. So you have to decrease the investment in equity. So again, you will sell the units. So this is the revised units and you will calculate so on. So over here, this is giving you the total portfolio value at the end, that is 2,40,647.58. This is the total value of your buy and this is as per the constant ratio plan. Now you will calculate as per the buy and hold policy. So you have invested 1 lakh rupees in equity and that was made at the NAV of 40. Now the NAV is 52. So what will be the value of this portfolio plus 1 lakh of your conservative portfolio? So this will give you the value in the buy and hold. So your value in buy and hold is more than the constant ratio plan. So buy and hold strategy is better than the constant ratio plan. So this is all the practical questions. Now we will complete the theoretical part which is being added in the evaluation of the mutual funds. So over here, the evaluation of mutual funds should be made on time to time basis, at least one time in 3 to 5 years. And for equity, you should evaluate every 6 to 12 months. So this is, you should evaluate the mutual funds from time to time to know whether they are giving you the good performance or not. So they could be, evaluation could be based on quantitative parameters and qualitative parameters. Now, quantitative parameters which include the numerical calculations in that, and qualitative parameter means which are the non numerical, that is like quality of the portfolio. So we will learn about the qualitative parameters also and quantitative. So first is risk adjusted return. You can use the risk adjusted returns like Sharpe ratio, Trenner ratio. Then you can consider the benchmark returns. You will compare your returns with the benchmark returns to decide whether you are having good returns more than the benchmark or not. Then comparison to peer. So if your fund is like the dividend yield fund, you can compare that with the other dividend yield fund. So you can make the comparison with peer. Then you can compare the return across the economic and market cycle. So what is the returns for a particular period? Like say for example, in the COVID times, there was a change in the economic scenario. So you can calculate what is the return in the COVID times. So based on the economic or market cycle also, you can compare the returns. Then you can use the financial measures like expense ratio, Sharpe ratio, Trenner ratio, and Sortino ratio. Then qualitative parameters are quality of the portfolio, track record and competence of the fund manager, and creditability of the fund house team. So you should know the quality of the portfolio. You should see how the fund manager has given returns in past, what is his competence, and what is the creditability of the fund house, whether they are paying dividend timely, whether they are giving the redemption amount timely or not. So you can see that various factors to decide the evaluation of mutual funds. So risk adjusted return could be relative to the risk. Then benchmark, compare with the benchmark returns considering alpha. Then compare with peer and calculate the return across the different economics. So because there could be a time where all the funds are performing, giving the outperforming or underperforming. So you can ignore that time or consider the evaluation for the normal time for the future period. So you can use the expense ratio, Sharpe ratio, Trenner ratio, Sortino ratio. So Sortino ratio is the variation of the Sharpe ratio where the downside deviation instead of total standard deviation is considered. So in the Sharpe ratio, we consider the standard deviation, but over here we considered the downside deviation. So what is the decrease in the deviation? We have to consider that in the Sortino ratio. So over here, if you see, this is the returns comparison with the peer. So this is like dividend yield funds. So you can compare this with the other funds to decide whether they are giving you good returns or not. Then you can refer to this ranking also. So this is 1 star, 2 star, 3 star, 5 star. So that are based on the performance they are giving. 5 star is a good mutual fund and 1 star is a low rated mutual fund. Then you can use the alpha, beta, Sharpe, Sortino ratio to compare and decide whether this is a good mutual fund or not. Then qualitative parameters, you should see the quality of portfolio, whether the companies included in the portfolio are the blue chip company. They don't carry the risk of the bankruptcy like distressed securities. And they should be large companies. If you are considering the debt, you should consider the credit quality, modified duration for that, portfolio turnover ratio for that. So these are the qualitative parameters you can consider to decide the quality of the portfolio. Then you should see the competence of fund manager and creditability of the fund house. So over here, if you see that this is the turnover ratio and this is the expense ratio, so you can know whether they are giving good returns or not. You can compare the expense ratio also. Then if you are considering that, you can consider the modified duration, yield to maturity also. You can decide with this whether the quality of the portfolio is good or not. Then if you see that Mudud Housing Finance Company Limited, so it has CIL rating of A plus. So that is a stable rating, good rating. So you can consider to make investment in such type of funds. Then see like over here, there is Roshni Jain and Dhruv Muchal who are managing the funds. So Roshni Jain is CFA, ACA and PGDM. So this is the qualification, this is the experience. They have worked with Franklin Templeton, Goldman Sachs and Singapore Wipro Limited and SR Bartley Boy. So this gives you the exposure they have, and which with you can evaluate that they are competent to take up the management. So you can evaluate what returns they are giving you in the other schemes also. So Dhruv Muchal is also BCom, CA and CFA. So you can know the competency of the fund manager and see the track record they are giving the returns. Then what is the role of a fund manager? So fund manager is a gatekeeper of the funds. So he has to manage that funds. Now, when there is actively managed funds, there could be actively managed and the passively managed. Passively managed means just you have to follow someone else. That means, say for example, it is index funds. So they have to just follow the index fund. And when there is actively managed fund, that means the manager has to decide which equity share to make investment, which debt instrument to make investment. So over here, they have to consider the extensive research. They have to decide, make the judgment. They have to consider the due diligence, whether they are working in a right way or not. And their motive should be to generate the positive alpha. If they are earning more than the benchmark, then it is satisfied returns. Then considering about the passively managed funds, so passively managed funds will follow the returns of their benchmark. But over here, they have to control the tracking error. They have to see that there should not be the difference between their fund and the benchmark. This difference should be minimum. So they have to match the returns considering the minimum tracking error. This is the motive in the passively managed funds. Now, beside this, they have the other roles also in the compliance. So they have to give the information to SEBI, AMFI, report the expense ratio, redemption of the funds, make the investor aware of any significant detail in the mutual fund, and furnish the required documents. So over here, if you see the example that SEBI have fined DSP investment manager for expense ratio violation. So over here, they have wrongly calculated the expense ratio. For that, they were charged 1 lakh rupees penalty to each and every trustee and managers. Then if you see SEBI slaps 1.6 crore penalty on Kotak AMC and 6 others for flouting the mutual fund rules. So over here, they have invested in a SL group, which was a distressed security, and they have not given this information to the unit holders, and they have extended the redemption date, and they have not completed the redemption on time. So the information was also not given, and the redemption was also made late. The information for that was not given to SEBI. So SEBI has raised the penalty of 1.6 crore on them. So it is not like the fund manager just have to manage the funds, they have to look onto the other rules also. Then constant monitoring the performance of a fund and creation of wealth and protection. So they have to protect the wealth, create the wealth, and monitor the performance. So this is in line with their main function. So over here, they should consider the fundamental technical analysis. So over here, if you see that quality and growth style of investing made Axis Blue Chip Fund the topper among the large cap funds. So with the proper monitoring and proper analysis, the fund can generate the maximum returns in the industry. Then comes the control over the work outsourced to third parties. Now, the mutual fund also outsource some work to the third parties, but the fund manager should check whether they have done the work in a proper manner with the proper process or not. They have to ensure the due diligence is being done properly. So for this, the SEBI has issued a guidelines on outsourcing of activities by the intermediaries. They have list out the activities which you should not outsource, and if you are outsourcing the other services, then how you should control the quality of that services, that is also being given in this guideline. So this is giving you the guideline to maintain the quality of the service to the unit holders. So this is for evaluation. And the another newly added topic is roles of FII. Now, what is FII? FII is foreign institutional investor. Now, these are the large foreign groups which has substantial funds. They are registered abroad, but they are making the investment in all the other nations in equity market or hedge funds, pension fund, mutual funds. So they are making the investment in hedge fund, pension, mutual, and equity market. Now, this FII have a very strong research team. They make the investment to take up the market in a bullish way. So this is a very important source of capital. The foreign currency will inflow in the market. So they can buy directly through a registered stockbroker, which is within the limits notified by SEBI. So SEBI has fixed limits for FII buying. They have to buy within that limits through a registered stockbroker. So whenever they buy, there is a strong inflow of the foreign currency. So there would be enhanced corporate governance. Enhanced corporate governance means whenever the FII invest, they carry out the due diligence very, very seriously. So the companies will try to perform in a good manner to improve their due diligence ratings. So the FII can invest in that company. So the governance will be improved. There would be improved competition in the market. There would be improved inflow of the capital in the economy. And this will generate the employment, and position of foreign exchange will also improve when FII are making investment. So this is the benefit of investment being made by FII. You have enhanced corporate governance, you have inflow of capital, competition improve, and the position of foreign exchange also improve. So if we see over here, this is an FII data. This is daily data. So on February 9, if you see, they have made investment. So over here you can see there is a positive change in a market. Whenever the FIR selling, this create a negative impact on a market. when they are increasing, so returns will increase. There could be the different scenario also, but generally this pattern follows, like whenever there is FII investment, the market will grow, or whenever the FII divest from the market will decrease. So this is how FII can impact the returns. And with this, we have completed the entire chapter. This is a very simple chapter. Just go through the concept notes once and practice the question by yourself and give the test. Test is must. Please give the test for each and every chapter and then only move to the next chapter. So best wishes to everyone. Thank you.